Right. Everybody's settling. Great. Okay. Let me say a few things to open our conference. On behalf of CEPR, CECIFO, and SciencePo, and myself, I would like to welcome you all to the inaugural conference of Economic Policies, Papers on European and Global Issues. This is our first conference, and the topic is what is next for Ukraine. Today and tomorrow, we will learn the answers to this question from the authors of 4 excellent papers that will be discussed by distinguished economists. We will also hear from today from former and current policymakers during our panel on their wider views on Europe and the global economy. And in fact, in this newly oriented publication, Economic Policy Papers on European and Global Issues, EPPG, our aim is exactly this, to run this message home. European issues are global issues, and global issues are European issues. On our new format, let me say a few things. We take our inspiration from Brookings Papers on Economic Activity, and we aim to be the key platform for high-level independent, policy-relevant debate, reinforced by the state-of-the-art academic research. We believe this new approach will foster a much-needed pan-European debate on the most pressing global economic challenges. And given this, we hope to see you in all our conferences. We are going to have 2 conferences every year, one in Paris in the fall, December most likely, one in Venice in the spring, June most likely. And our second conference is going to be on June 19-20 in Venice. We are hoping to see you all there. And the topic of that conference will be globalization and fiscal populism. On that note, I would like to invite my guest editors who are helping me on this What is Next for Ukraine conference, Simeon Janko. Specific to this issue. Go ahead.
Thank you. Just a couple of words, well, to welcome you to this event, but also to say that at the start of this work, Yuri and I actually started talking nearly 2 years ago and wanted to have top academics linked in their analysis to the European Commission, which we thought then and even more now thought that the European Union would be the main funder of, at least initially, of what would be the reconstruction of Ukraine. So we thought that it is very important for the research that you're doing to be directly related to the top of the European Union, the European Commission, and of course the Ukrainian government. At the time when we started talking about this initiative, Yulia Sviridenko, who was the Minister of Economy of Ukraine, was the third spoke, so to speak, with me and myself and Yuri. Since then, she's become the Prime Minister of Ukraine, so she's not here. But I speak to her often about how we are doing with the conference. And in fact, just after this conference, I'll have the opportunity to meet her and both present the papers. Sebnem has been very harsh about don't send anybody any papers before they're presented. So I have stuck to that promise. And also in Brussels with the Vice President of the European Commission and Commissioner for Budget, Valdis Dombrovskis, who is Latvian originally. He runs the budgeting for, or rather his office runs the budgeting for Ukraine. And most likely will be the base of a future institution, agency, I don't know how to call it. This is still in political discussions for a fund for the reconstruction of Ukraine or some sort of a European institution that will pull together, hopefully, the knowledge from what you're providing to policymakers in Ukraine, in Europe, and globally as well, because Europe would not be able alone to fund this effort. So there has to be a space where top research analysis are married with hopefully smart political decisions, both at the national level and global level, to get us where we would like Ukraine to be in the future. Thank you.
Thank you very much. And now we are going to move on to our panel, and Beatrice Weder Mauro is going to chair the panel. So I would like to invite all the panelists to the podium, please.
So let me start by saying thank you. Thank you, Shebnem, for inviting me to moderate this panel. The timing couldn't be better or worse. At the same time, probably a little bit of both. But I did, before coming here, actually look at, from the perspective and with my hat of CEPR on, over the last few years, what we have been doing on Ukraine. And in many ways, this is a very, very straight line, if not, a culmination of work that has been led mostly by Yuri, whom we have short-term added to the panel and who has kindly agreed to add on to our discussions. Because, of course, of all of us, he is the one who is closest to what is happening and has been so for all of the previous years. Yuri is the Ukraine initiative leader for CEPR. And if you are not aware of this particular initiative, there is a website that collects the output. And I had very recently a discussion where a very eminent German journalist came up to me and wanted to talk about reconstruction of Ukraine. He wants to write a book about it. And he very much remembered that very first policy brief, Yuri, that we wrote and which initiated the series of rapid response economics, as we now call them. Because it was really a rapid response. If I'm not mistaken, it was published already in April or end of March after the invasion of Ukraine, when, the horrors of Bucha and, everything was still very much unfolding and becoming visible. And at the same time, we were putting down principles for reconstruction. Now, these principles for reconstruction, and I did reread them in the occasion of that interview, are still very, very sound in many ways, but although in others, they do have to be revised because the power structure between Europe and the US, for instance, looks very different than it did a few years ago. So just as a last point on this Ukraine initiative, it is by now almost 700 pieces of output we have published. So I really think CEPR we can call ourselves Ukraine Economics Central and have been very proud to be supporting this type of analysis, research and policy work. When the idea of having the first inaugural EP-PEGI conference and therefore also publication be about Ukraine came up some 6 months ago, maybe it's now 9, it didn't look as pertinent as it is again looking right now. But it was always a good idea, and I'm glad that we went along, and that we now will be having the possibility to have papers, discussions over the next week, over the next days, but also going forward. So with this, let me introduce my panel here. Linda Goldberg from the Federal Reserve Bank of New York. She is a financial research editor and a distinguished fellow. So always the CEPR hat also matters, a distinguished fellow of CEPR a loyal friend and has been coming to Paris symposiums several times. Catherine Mann, Brandeis University and a member of the MPC of the Bank of England, is second in order of presentation. And again, a very long friend of CEPR. I have already talked a lot about Yuri and Sergei, the Dean of the London Business School, and previously from his CEPR he was leading the Research Policy Network on populism, and has, of course, written extensively about these issues that we'll be talking about. So in terms of the timing, Linda and Kathy have a presentation, 10 to maximum 12 minutes each, please. You can speak from here or from there. And so why don't you take us away?
So happy to be here. So I'm going to speak on my own behalf and not on behalf of the Federal Reserve Bank of New York or the Federal Reserve System. I will not talk about the economic outlook or monetary policy also, because we are in the Federal Reserve in a blackout period. So what I'm going to talk about are sanctions, and I'll talk about their types, their usage, and research findings. And I think that'll set up nicely the content that Catherine will talk about in terms of implications for countries and policies. Okay, so, and I won't talk for a really long time. I mean, we'll have a lot of discussion afterwards, but I wanted to lay out that there are different types of sanctions. There are some that are kind of weapons related or travel related, but the two broadest groups are trade and financial sanctions. And these have been used really for quite some time. Some examples of, it's not that this is a new development in the last 10 to 15 years. Examples, for example, are on financial. The EU sanctioned Iranian banks and cut them from SWIFT in 2012. The US, an example, froze assets of individuals with links to North Korean arms dealers. Only trade type sanctions. Examples are EU bans of imports of Russian seaborne crude oil, which we'll come back to, or the US imposing a trade embargo against Sudan in 1997. Then there are ones that are neither trade nor financial. For example, Russia banning Georgian residents from entry, or Australia imposing an arms embargo against Russia in 2014. And then there are ones that are joint trade and financial. For example, Canada prohibiting both the transfer of bulk cash and the export of luxury goods to North Korea. So you see there's a variety of types and a variety of countries. There are some very good databases that go through all these types of sanctions. Also gives details on what are the stated goals of the sanctions, and sometimes if the sanctions have been closed out, their assessments of whether the goals have been met by the sanctions. But that is very much a subject of research and a lot of work in the political science area. All right. the other slide. All right. So we have here's YouTube. Okay. Just put it in the other mode then, and let's go back. Okay. So, okay, so sorry that, viewing it in this mode. So if you think about the biggest imposers of sanctions, these are the G7 countries, while that's coming up. And the use of sanctions and the number of sanctions has grown quite a lot over time. So in the 1960s, for example, there were under 10 active sanctions at a time. By the 1990s, it got up to about 25. And then by the time you got to the, kind of 2012 to 2014, it came up again, and now we're at like record levels of sanction use. The sanctions imposed by G7 countries account for about 61% of all sanctions. And you could see on this slide by color coding the prevalence of different types of sanctions. So pink is when a sanction is both trade and financial at the same time. The green bars are the ones that are only financial sanctions. So you could see that financial sanctions are increasingly used by G7 countries. Now, this growth in the number of sanctions, I'll come back to that in a moment, but that doesn't mean growth in the economic effects of sanctions. Okay. So who's imposing these exactly? Well, here you have from 2012 to 2023, Canada, Euro area, Japan, United Kingdom, and United States. And you see that the US by far is the largest user of sanctions as a tool, followed by the Euro area and the UK. And again, you see the types where financial sanctions are a big part of what's going on here. But again, if it's not only exclusively financial sanctions, there are a lot of sanctions that are joint trade and financial. So we really have to kind of think about those effects. Now, in terms of countries that are targeted by sanctions, a lot of the research that this group has done, and I'll point to some of that research, has talked about basically sanctions against Russia. But in fact, the longer literature and the political science literature, really pays much broader attention to other countries as well. Here you see the top 10 countries that have been targeted by G7 sanctions. And yes, Russia's up there. Iran is also up there, and as is China and Belarus, which is often sanctioned side by side with Russia. Again, with this paying attention to the blue, to the green, and the pink bars. Now, within financial sanctions and in sanctions more broadly, I showed you this big run up in the number of sanctions that are out there. There's been a real shift in what kind of sanctions are used. So in my work, I categorize sanctions into broad versus narrow sanctions. In the kind of literature, there's also a terminology of more targeted sanctions being used. What it means is that whereas previously countries were sanctioned, large blocks of activities were sanctioned, increasingly over time, sanctions were applied to also put pressure on individuals and to through those individuals to punish those individuals or to exert political impact. So, so this shows you with the light green that those are narrow sanctions, those ones that are targeted more at individuals, maybe small companies, maybe smaller actions, whereas the broader sanctions, which are the darker blue, and then both, which are the lighter blue, are a much smaller number of sanctions. And when we think about economic impacts as opposed to political impacts, I think that's where kind of the focal point is. So then just getting to the effects of sanctions before I wrap up. Here it's small print currently, as shown, but here's a number of excellent recent studies that go through sanction episodes. Many of these are the trade or financial sanctions that are on Russia. So I put them here for your reference. Some of the authors are here in the audience. What are the key lessons before we kind of wrap up this part and get to the rest of the panelists? First, first applies to trade reduction and trade diversion. So when sanctions are implied, particularly trade sanctions, the firms trading with sanctioned countries risk reputational costs, and they risk secondary sanctions. And so one study shows that, for example, using data from Turkey and other countries, that when firms are Western-oriented multinationals, they will actually withdraw from trade with Russia. But other small and medium-sized enterprises tend to make very different choices and are more willing to risk secondary sanctions and be a source of kind of undermining the actual impact of the sanction by trading themselves. Exports and imports are documented extensively to be rerouted through third countries. And there's, within the sanctioned countries, some domestic substitution leading to higher costs and fewer varieties. When sanctions are imposed, in particular on trade, exporters to sanctioned countries seeing a pullback of other exporters from that market earn higher markups and prices. And the exporters in the sanctioned countries accept deep discounts on their sales as the foreign buyers have more bargaining power. And for example, in the work on oil, that's beautiful work, by the way, that's been done, that's really nicely documented. In terms of financial and insurance network restrictions, sanctioned countries, again, looking at the oil trade or even goods trade, sanctioned countries take on riskier and costlier routes and activities. In shipping and oil, they switch to dark fleets and longer shipping routes. And then there are the costs of loss of access to payment systems and reduced capital flows through those channels. There is evidence of trade and financial flows realigning within geopolitical blocs. And the macroeconomic effects, there's a range of studies that debate the magnitudes of these, but basically export sanctions and asset freezes are associated with depreciation of the targeted country's currency, import sanctions, appreciation. Oleg's done a lot of work on this. Sanctions on central bank assets historically applied are argued in one study to potentially backfire by increasing interest rates for the sanctioning country, and overall that sanctions reduce GDP growth, have broad negative effects on consumption, investment, and trade. So I'll turn it over to Catherine.
Thank you very much, Linda.
There we go. Thanks very much for the opportunity to come and talk about the implications of Russia's invasion of Ukraine for a small open economy. It's the United Kingdom, small open economy with a large financial sector. So the shock that we're going to be talking about, of course, is the energy price shock that was associated with Russia invading Ukraine. And we're going to find that that shock precipitated a variety of policy responses, not just by the Monetary Policy Authority, but by the fiscal authority as well. And that changes the dimensionality of how we think about the shock. And we also end up with a much more volatile inflation environment. And that volatility in the inflation environment is going to have implications for price setting behavior of firms and expectational behavior of households and consumption by households. And so this shock that often in theory we think about, oh, it's an energy shock. Monetary policy should look through. We've ended up with a situation where we have persistent inflation and quite probably structural changes in pricing behavior of firms and consumer behavior of households. So that's the bottom line, and now we'll see it in pictures. So this is a standard type of decomposition to get a flavor for just how large the global shock component of the inflation process, headline inflation process in the UK was. The global shock, the amount that came from basically Russia invading Ukraine. That's what happened. There was a little bit at the beginning that we can talk about as being the sort of the end of the COVID period. But the majority of what you see there is an energy price shock. We do have a little bit of the domestic shock. That is the end of the COVID period in aqua. This is the decomposition that I think is an important one when we think about how different policymakers, the different groups of policymakers responded to the shock in the United Kingdom. If you look at this, the latter part here on the right-hand side, most people think of the energy shock as a supply shock, which it is. However, in the United Kingdom, the fiscal response to that energy price shock was really quite large, and it turned the supply shock effectively into a demand shock. So that aqua that you see is the manner in which fiscal authority tried to mitigate the shock, the energy shock on households, primarily households, not so much on business. You would get a different decomposition if you were to do this type of exercise for Germany, for example, because they had a different institutional strategy for dealing with their energy shock. So this is a particular nature of the UK. The second thing to take away from this is that you can see that monetary policy was not tightened enough or soon enough as the shock was percolating through the economy. What I can say, since all my votes are known, is that when I saw some of this information, and I could look at the distribution of data coming in from firm level data on the expectation of what firms were going to be doing a year ahead with their own pricing strategies. And I could look at those distributions and I could see that there are very, very heavy right tails. And so in my analysis and my votes, I voted for bigger hikes sooner than was in the committee. And as I say, you can see in the monetary policy purple there, we should have moved sooner and by more. So other ways in which we can kind of evaluate the extent to which the shock affected the UK economy is it's not just the effect on the UK economy, of course, the global effects as well of of the energy shocks, and those were different in different economies. And the policymakers, both monetary and fiscal policymakers, responded in their own way. But we can decompose all that and get a sense of how large the spillovers from other economies, policies, and macroeconomic outcomes affect my 10-year gilt yield, which is an important indicator of the state of financial conditions. And you can see there that the global risk factor, the dark purple, is a very large component of financial market conditions tightening. But at the same time, US policy was counteracting that to spill over to loosen financial conditions in the UK. You can see that UK policy and UK macro, the aqua there, especially the UK policy, which is the dark aqua, it makes me feel a little, uncomfortable that the dark aqua, which is what I do, is like the smallest item on that chart. But, we have to do what we have to do, which is to lean against spillovers at times. There are times, and again, my votes are documented, there are times when the financial conditions in the UK have been dominated, and you can see a couple of times here that dominated by foreign spillovers. And I have had to make votes that are explicitly communicating to the financial markets that what they have spilled over to my markets is a financial conditions that is inconsistent with the underlying activity and inflation dynamics of the UK economy. Another way in which we can evaluate, could you push it, please, since it doesn't seem to want to go? Yes, we can also look at the implications for the sterling. This is the most recent year. We can look at the implication of sterling again for how much my policy drives sterling versus other policies. And Europe, for example, Japan is becoming much more important. It's not on this chart at this point, but it is an important factor. I think it's you can see here the global risk, which is the purple, and that correlates to a variety of risk indicators that are correlated with sort of the tariff news. And you can see April there is where the global risk factor starts to appear in the decomposition and affecting sterling. Also affected the dollar, obviously. That's the bilateral. So I'm going to skip that one. So what is, so here we have an environment where we have we have a big global shock, we have global spillovers, monetary policy and fiscal policy react to that. It creates an environment where we are trying to lean against the inflation impetus. As I say, I don't think we did enough or soon enough. But we're making progress. We're making progress, but it's slow. And there are consequences of both high inflation as well as volatile inflation. So this is just your picture of where high inflation comes from in terms of the components, and that you can see that, our headline inflation, our target is 2, and we are not there. We're at 3.4 or so. And that the components that drove the shock, the peak, was food, was initially electricity, gas, which is the energy component, and then a year later, food, because of the fertilizer input lag. And we've gotten rid of a lot of that, but it has become embedded in labor costs and therefore in services prices. So this is kind of where we got a problem, because what we have found is that when you have food inflation running, services inflation above target, and food inflation running it at 7% and higher for a long time, you end up with inflation expectations for households being driven away from target consistent inflation expectations. And you can see this exercise of different time horizons for inflation expectations, perceptions, then expectations over time, And so the salience of food becomes very important in driving inflation expectations. The other matter that matters is when we hit a threshold of 3 to 3.5% with our headline inflation, we end up with any additional shock. Like when we get it down below 3, we're still going to be in an environment. If we get another shock that puts us above 3 or puts us above this threshold range, you can see that the inflation response of inflation expectations and CPI inflation is quite dramatic. And that if we were below that threshold, which is the blue line, we would be fine. That's well anchored. And we're a bit of a trouble here. We're a bit of a trouble here because we are above the threshold and we're in an environment where we're more likely to have positive shocks than negative shocks. I will leave that one out. But I do want to show you the extent to which the high inflation environment also affects firm pricing behavior. If you are in a high inflation environment, then if you get a negative sales shock, which is kind of what a monetary policy tightening is supposed to do, right? It means that you don't get as much of a reduction in prices as you would like to see. It's nonlinear. So firms are unlikely or do not incorporate tightening sales into their pricing strategy. So it means we have to work hard to get pricing strategy inflation down so that we end up with this low inflation environment on the right-hand side, which is basically linear. Strong demand, prices go up, flat demand, prices go down. That's not true when we're above this threshold of 3 and 3.5. The last point that I think I want to make, because I think I only have 1 minute to go, 0, is inflation volatility matters for consumer behavior. And what this exercise does with a randomized controlled trial on inflation surveys is that when inflation volatility goes up, inflation uncertainty goes up. And when inflation uncertainty goes up and inflation volatility goes up, you end up with a downward relationship between expected income and expected spending. So the story here, it goes back to Greenspan. Greenspan basically said, we know when we've hit price stability, and I work for Greenspan, we know we've hit price stability when households and businesses do not incorporate inflation into their decision-making. And I've just shown you a whole bunch of slides that says we are not there yet. And inflation volatility in particular is yielding consumers increasing their savings buffers. And so regardless, even if you would like to kind of tighten, even if you're afraid of tightening, there's a variety of people who don't want to tighten monetary policy anymore, do not want to have any more period of restrictiveness. Until we get inflation volatility down, inflation down below our threshold level, we're going to have the problem of consumer behavior being slack because their savings buffers on account of inflation volatility. So consequences of one shock, a very big shock, having persistent effects, both on an economy that is kind of a long way away and through spillovers.
Thank you very much, Catherine. Sergei, you're next.
Thank you very much, Beatrice. You asked me to talk about the post-war reconstruction. I don't need any slides because, as you rightly said, everything which was written in the spring of 2022 still is relevant. So indeed, in the spring of 2022, Beatrice asked us, and the work was led by Yuri, and there's some of the authors around this table, to think about post-war reconstruction. I think it was a very important piece of work. Why? Because indeed, it was charting the future for Ukraine, signaling to Ukrainian soldiers what they're fighting for. And actually, I'll talk about reconstruction, but one of the things we talked about in that paper was candidate status, accession. And I was really impressed to see that the Commission granted the candidate status already a couple of months later, which of course created the desired outcome for Ukrainian public, for Ukrainian society, for Ukrainian government. to fight for. Now, when we think about the reconstruction needs, at that point it was completely unclear how big the reconstruction needs will be. But at that point, we already looked at the precedent of the Marshall Plan. And it is hard to imagine, but Marshall Plan in nominal dollars was in the range of 13 billion for 4 years. So every year, US would spend 1% of GDP. Now, if you think about 1% of GDP today, that would be 300 billion per year, right? 300 billion per year. US is spending much less. Europe is spending much less. But even if you just look at inflation-adjusted volume of Marshall Plan, those billions in 1948 dollars would turn into 160, 170 billion dollars for the whole of Europe, right? So when we start thinking about those numbers, suddenly it turns out that in Ukraine, the needs are now estimated at $500 billion. So the World Bank's latest estimate, which is December 2024, estimates the post-war reconstruction needs of Ukraine at 500 billion euros, give or take. And I think the December 2025 will be a new estimate. There is also an estimate of direct physical damage, which is about $200 billion. So just when you think about the magnitude of this amount, it is bigger than inflation-adjusted Marshall Plan amount for the whole of Europe in 1948, 1952. So this is a big amount. And the question is how to pay for it, who is going to pay for it. And of course, this is where the frozen assets come up. And again, Beatrice asked me to talk about this in this paper in the spring 2022. We already said that this should be the main source of paying for post-war reconstruction in Ukraine. The issue is moving very slowly, but it is becoming clearer and clearer that European and American taxpayers are less and less likely to approve using taxpayers' money to dedicate to post-war reconstruction of Ukraine. And when you think about the fiscal space today, for the reasons that Catherine's mentioned, for other reasons, big European countries and the US are running very high budget deficits. Now, if you told me that US would run 6 or 7% of GDP when the economy is not actually in recession, I would never have believed it. But this is true, and this is actually true in other countries as well. But, well, this country or UK cannot run a 7% of GDP deficit because that would be what they call a least trust moment. But they happily run 5% of GDP, 5.5% of GDP fiscal deficit, and there is no space anymore. Why? Beatrice mentioned that we had a research and policy network on populism because the incumbent governments are under pressure from populists and they're afraid to stand up to populists. So, for example, we just had a budget in the UK. In the UK, the government is scared of cutting spending because this is where they think they would lose votes to the Reform Party. In this country, as you know, the budget is a very important issue, and we lost several governments over the budget, and one government decided to stick to its offices at the price of going back on pension reform. I see a lot of people around the table coming from countries where pension age is 67 and maybe pushing up to 70 plus. In France, as you know, the reform was to move from 62 to 64, and it's frozen at 62 3/4. So yeah, I see not everybody's convinced this is where life expectancy is. So seriously, there is no fiscal space, neither in France nor in the UK, nor in Italy. There is fiscal space in Germany, but again, there is also a number of issues in Germany. So there is a major ask from European voters to get somebody else to pay. And it is a reasonable proposition to use the frozen assets. Now, today, as you know, the European Commission is pushing for a very elaborate solution which involves using this money as a collateral for reparation loans to Ukraine. So the idea is there are several ideas floating, but the idea is not to expropriate this money, but instead lend this money to Ukraine, contingent on Russia paying back reparations to Ukraine. So when Russia pays back reparation to Ukraine, Ukraine has to return those reparation loans to Euroclear or special purpose vehicle or whatever entity is created, and this entity will refund this money to Russia. So this money remains Russian asset, but it's contingent on Russia paying or not paying reparation payments to Ukraine. Now, is that legal? It's not clear. To what extent Belgium or Euroclear or Europe is vulnerable to potential future lawsuits from Russia is not clear as well. Now, what is clear, and unfortunately we lost a lot of time on this, is that we still don't have a court decision against Russia obliging Russia to pay reparations to Ukraine. Such a decision would immediately create a legal opening for Ukraine going after Russian assets. And then, of course, if there is an international court decision saying that Russia is supposed to pay to Ukraine 200 billion or 500 billion, then I would bet my money that Mr. Putin would disagree with this decision and will not pay. But with this court decision in hand, Ukraine would be able to come to Euroclear and claim these Russian assets. At this stage, we hear both from European Central Bank, Belgium government, and Euroclear that they are not in favor of giving those Russian assets to Ukraine for post-war reconstruction. And they're probably right, because each of those entities have their own mandates. ECB says if we weaponize euro, we will not be able to develop euro into a global currency. And of course, risks for euro and euro assets, confidence in euro and euro assets would be affected, but much more is at stake. And even though ECB's mandate is to protect euro as a global currency, there are other issues that can be considered. ECB should look after what it's supposed to look after, but this is a political decision which puts Ukrainian reconstruction at stake and the future of fiscal stability in Europe as well. Same you can think about Belgian government, where Belgian government correctly says, if Putin sues us and we lose, why should we be alone in this? Can we provide sovereign government guarantees from all Europe? And Euroclear, by definition, says the same, saying, look, there is a client who entrusted a few $100 billion with us, and you're saying that we should move it somewhere. Give us a legal justification to do it. And again, this is not the job of Euroclear to interfere in geopolitics, sanctions regimes, and Ukrainian reconstruction. So it's a company with a management board, and it should look after its narrow mandate. Now, this is a very painful discussion, but just to summarize, there is no other choice, because we see that in every country on this side of the Atlantic, you have growing popularity of populists, and if you use taxpayers' money in those countries for reconstruction of Ukraine, it will be adding votes to those parties which are openly or implicitly supporting Kremlin. The implicit argument is, of course, Mr. Putin's changed. The nice Mr. Putin that we used to know before 2022 is no longer there. Now it's a bad Mr. Putin. We don't like him. We don't like his war, but we don't have money, soldiers, weapons to stand up to him. And if we use sanctions, sanctions will backfire and hurt our own economy. And if we expropriate his assets, it will undermine confidence in euro, and so on and so forth. So it is not unlikely that those parties will take over, and that will result in more negative implications for for Ukraine. Now, what's happening on the other side of the Atlantic, luckily, is outside of today's discussion. But again, there is no source for optimism as well if you look into American politics. So let me conclude. This is a huge project, and Yuri will talk about principles for governing reconstruction. That's yet another thing which we covered in that paper. Continue to work on afterwards. There are all kinds of issues about governance of spending, several hundred billion in Ukraine. There are also all kinds of issues related to sudden influx of foreign currency into a country with reasonably shallow financial markets, what kind of impact it will have on the exchange rate, and structural change because of price of labor and other changes. But I think the number one issue, which is the elephant in the room, is how we use Russian assets to pay for it. Thank you.
Thank you very much, Sergei. Yeah, yes, indeed, and you did not leave us with much hope on that front, explaining very clearly what the positions that are blocking any solution right now are. And by the way, the 600 billions in costs is already something that we had miraculously, because at the time it was really just an estimate based on very very little evidence, but that already in our paper of the time, the 600 is already there. I mean, I was quite surprised to find it again. Sergei, Yuri, if you maybe can also tell us what you think, where we stand and where do we go forward. And let me say that, until a few weeks ago, I would have said there will be a solution on the frozen assets, but with the new peace negotiations where, the US is now also trying to get a peace, that seems to be even more complicated than when it was an intra-European story. Where do we go? The big question is what's next for Ukraine? That's the question of our panel, and why we're happy to have you on it too.
Thanks very much. I think one thing which is useful to appreciate now is that we approached the 4-year mark since the beginning of the war. This is the period which is longer than the engagement that Ukraine had during World War II. So by now it is a very, very long war. And I think it gave us in Ukraine a lot of time to go through all stages of adjusting to a shock, right? So first you have denial, then you have anger, then you have bargaining, then you have depression, and then you have acceptance. You understand that this in here is going to be for a long time. And, when I come to Europe, I have a feeling, or the US for that matter, I have a feeling that we're still in the early stages of this adjustment process. We're kind of bargaining, right? We're trying to find a solution when it's very clear, there is no easy solutions here. You just need to accept and carry on, what you have to do. And in this context, I wanted to thank Shabnem and Beatrice and Simeon for timing this conference so perfectly. As we speak, there is a meeting of EU finance ministers trying to decide the fate of this reparation loan. And I agree with Sergei that there is really no other alternative. And the mess here is very simple. If you look at how much Russia spent on this war, in 2024, it was about $140 billion. Next year, the projection is to have $170 billion. The level of GDP for Ukraine is about $200 billion, right? So Ukraine clearly does not have internal resources to match what Russia is throwing in this war. Ukraine spends all of its budget on defense, which is about $60 billion. Then it got about $20 billion from the US in military aid and another $20 billion from Europe. Now, US is disengaging, which means Europe has to find another $20 billion in military support. But this is not the end of the story. We also have a huge budget deficit in Ukraine, about 20% of GDP. We need about $40 billion in budgetary support every year for the duration of this war. I don't want to make a forecast for how long this war is going to continue, but there is very little indication that Putin or whoever comes after him is going to stop immediately. So we should be looking about long-term solutions to this. And we have to find about $100 billion per year for multiple years, not just, this year, next year, or the year after. We should be thinking about a long-term solution. And as Sergei said, there is really no fiscal space in Europe or in many other countries to finance this kind of operation. We have to find resources elsewhere. And frankly, the only available resource we have is this Russian frozen assets that can be repurposed, if not for reconstruction, at least for supporting the defense effort of Ukraine. Now, US is not very helpful because I think they throw a lot of sand in this process because they start to claim, a portion of Russian frozen assets, and that's very unfortunate because it creates all sorts of frictions also in Europe. And all this, negotiations with Putin look very counterproductive in many ways. The joke in Ukraine is that when Witkov goes to Moscow, it's not clear who is representing the US. It's a great joke, half joke, but there is also an element of truth to this. But having said this, I think there are a few things which we should also understand about the kind of domestic policies we have in Ukraine, and I want to share 3 facts with you. One is, despite this enormous shock that hit Ukraine at the time of the invasion, we still have economy which is holding up reasonably well. GDP is projected to grow about 2% this year. Next year, we have about 10% inflation, which is not great, maybe. But, when you compare it to the UK, which doesn't have a war, it's actually not that different. So, it's a surprising resilience. So in this sense, Ukraine has resources to kind of keep fighting. That's number one. The second fact I want to share with you that I'm sure all of you heard about the corruption scandal that shook the country, and there is obviously very little pleasant stuff that is going to come out from this and will come out from this. But with this as the background, I think one great thing which came out from this was that actually anti-corruption agencies are fearless and they pursue high-level targets which would be basically unthinkable now in the US or in any other advanced economy, frankly. So there is something positive about this. And the third fact I want to share with you is that when you ask people, how long they can take it, roughly 70-80% of people say that they will continue, this war effort for as long as it needed. Right. So, when you look at the sort of totality of, facts we have here, this reminds me what Churchill was asking President Roosevelt in World War II. He was saying, look, give us the tools and we'll finish the job. I have the same feeling about Ukraine. It's true we don't have resources, but if you give us the tools, if this Russian reparation loan is going to become available, this is going to be a huge boost, not only in terms of morale, but also in terms of resources that are available to Ukraine. And, to echo a little what Sergei was saying about the ECB, it's true, we can have some debates about, what's the role of the ECB and all of this. But I want to remind everybody that ECB is supposed to be the lender of last resort. And, we're approaching this point where there is really no other option. They're going to be the last resort that can, make all of this happen. And I think they should internalize that, when you look at sort of totality of what is happening in Europe, they should understand that they have to play a role in this. It's a European institution, and they also have to contribute to the future of Europe that is going to involve peace and prosperity. So I'll stop here. Thank you.
Thank you very much, Yuri. So yes, the future of Ukraine and the future of Europe are very much interlinked, and this consciousness, I really appreciate the way that you said this. This consciousness is not equally developed everywhere in Europe. Definitely, there are some countries and also leaders who are very, very acutely aware of this fact. And if Russian drones appear over airports in completely unexpected places, then that accelerates the realization of how small this continent ultimately is. But we are running out of time very quickly, as always happens in good panels. And although we have prepared tons of questions, I have many for you. I will not use my position here. That's I'm going to give a round of questions. Collect questions from the audience. Please raise your little thing in front of you or your hand if you. Okay, so I have Shebnem, sorry, Ed Glazer and Paula. In that order.
Okay, so great panel. Thank you so much for all the insights. I want to go back to this point of ECB being the lender of last resort and what Sergei said about how they are worried in terms of the implication of this, because they are trying to turn euro to a global safe asset to rival the dollar, right? This is clearly now ongoing effort in Europe, rightly so. But you know, part of being a global safe asset and reserve currency also goes through being a lender of last resort. So why you think they put more weight on the credibility or weaponization of euro and less what Yuri is saying? You know, they are the European institution, they have to do something about their lender of last resort, in your view.
We collect the questions.
Three things. I want to make an observation, which is, while there is no moment in Harvard's history that I am prouder of than the moment in which George Catlett Marshall declared the Marshall Plan in Harvard Yard, we tend to forget too much the central role of Arthur Vandenberg, the chairman of the Senate Foreign Relations Committee, in making that happen. And in fact, it was a legislative achievement. The American Senate and House are still full of people who have traditional views on what we should be doing with Russia, and it ain't positive. Okay, and my question is, what is Europe doing? What is the Ukrainian thing doing in terms of working with the U.S. legislature? Second, and this is going to be really fast, Yuri, on corruption, where are we on sort of getting data, opening the books, we've seen lots of fascinating things that have come out of economic research of people figuring out various things around corruption. Is there anything in that space that sort of the outside research community can be doing to be helpful on that? And third, the Russian spending is amazing, but of course, American spending on defense is even more amazing, and I have no idea what we're getting for that spending, right? And the question is sort of, what do we know in terms of like dollar effectiveness of different types of spending? There was a great calculation that Neil Ferguson did in his first book, which is sort of dollars per death of the different countries during World War I, where sort of the Germans were just much better in sort of spending per death. And so if there's anything in terms of doing a sort of CPI on defense across countries, that would also be a fascinating thing to know about.
Thank you. My question actually follows Sepnen, and is actually specifically on Linda and on her work on the dollar. So do we have cases, because the dollar and the sanctions, there are many sanctions issued by the United States. So the impact on the dollars, if there is something similar to the proposed actions on the Russian assets. I believe there is a case in Afghanistan done by the United States, implemented by the United States. But again, as far as I know, there is very little impact on the dollar. So I wonder if there is an empirical study. And of course, Saudi Arabia has threatened to sell debts of European debt. But again, how to implement that? Because it is an interesting threat, but very difficult to implement it, and assuming that there is no reaction from the ECB. Thank you.
Okay, great. Why don't we take the remaining 7 minutes to respond to these questions? And I think Yuri and Sergei, in the reverse order of how you spoke before.
I think
So-
the program actually said we are finishing at 15:15.
So, okay, all right.
We have 7 more questions.
We have 7 more questions. Okay, great. Why was I rushing so much? Because you told me to. Okay, great. Thank you very much. So let's respond to these questions in peace and at leisure. But Yuri, the questions on corruption.
Yeah, so by its very nature, corruption is a hidden activity. It's very hard to detect. It's always changing, morphing into something new. But from the data we have in Ukraine, we know that petty corruption is almost completely rooted out. High-level corruption, it's, we now know it's not rooted out. There is a big issue there. But having said this, I think Ukraine is really ahead of many countries in terms of trying to minimize instances of corruption. For example, high-ranking government officials have to declare not only their personal incomes, but also incomes of their families, relatives, their own spending. So there is a lot of infrastructure there already. You just need to have sort of political will and courage to carry out this instructions from the law and make sure this happens. Russia spends a lot of money. Obviously, if we adjust for corruption, maybe it's going to be less effective there. But, one lesson I learned from Elena was that if you look at dollar spending in Russia, adjusted for purchasing power parity, you basically have to multiply it by 3. So you're looking at probably something like $500 billion, which is, not that far from the US. And in this sense, it's still a lot of spending power that goes into this war. So if you have a lot of volume, even if you lose a fraction of this due to corruption, it's still a lot of little power there. About the euro, one thing I wanted to mention, if euro really wants to become a global currency, seizing or not seizing Russian efforts, I think is going to be a second-order issue. What we really need in Europe is much bigger capital markets, more liquidity. It's number one. And number two, you have to have a lot more muscle. You have to have military power to project yourself, elsewhere in the world and make sure that people are not going to attack you and basically take over your assets. Thank you.
Yes, well, unfortunately, we don't have anybody from the ECB on the panel. we do have somebody in the audience, but I'm not gonna. Okay.
I mean, I'm not going to speak for the ECB, obviously, but there is sterling history, and the role, the evolution of sterling versus the dollar in terms of its role as international reserve asset. And I think there are some very good research. This is, of course, Barry Eichengreen, Arno Mauro, and co-authors that I'm channeling here. And the Marshall Plan cemented the dollar's role. Now, it was also true that everybody else was, war torn, but the global trade was dominated by the UK until the Marshall Plan money translated into US trade. And that, of course, as I say, cemented the dollar's role. And then at the same time, a couple of years later, beating the pound when it was down was the London Declaration, which was when the British Commonwealth turned into the Commonwealth. So the military alliances, institutional relationships are increasingly understood to play at least as important a role in driving international reserve currency status as sort of the economics of, unit of account on financial transactions and trade invoicing and so forth. The paper that I think anybody who was interested in this should read is, you just look up Eichengreen, Mars and Mercury is the paper that really digs in. And they have a subsequent paper that actually starts to look at the different kinds of capital controls or other efforts. Controls are you don't want to use your currency, but there are other sort of motivation to try to increase a use of currency for international reserve status.
I think ECB is a European institution, but it's a central bank. It's not up to the ECB to make those decisions. The assets were not frozen by ECB. They were frozen by heads of governments and heads of states on the third day of the war. It's a political decision because these people are accountable to their voters, and they need to make sure that Russia doesn't have access to those assets to recruit more soldiers, produce more drones, and so on and so forth. And I think it was a political decision, and whatever happens to those assets, it's not up to ECB to decide. ECB has a very clear mandate. They don't have a mandate to fund military production. They don't have a mandate to think about how to shoot down drones in Berlin or Copenhagen. Their job is Euro. And I think sometimes you face trade-offs, as Yuri said. Yes, dollar is losing its role as a global reserve currency, answering Pavel's question. Slowly, these things don't happen overnight. Dollar is still a global reserve currency. We did see a very unusual set of movements in April, right? After Liberation Day, we suddenly saw that dollar is a bit like of an emerging markets currency now. People who want to build a new reserve currency suddenly woke up and said, how about we build our currency into global reserve currency? As Yuri said, a lot more needs to be done. Euro bond market is very small. Hence, those ideas issue more joint bonds to fund joint defense production. We see those papers circulating, including by people from CEPR, and that's great. But I think overall, when you think about those issues, Euroclear is a company. They have a board. The CEO, Valérie Urbain, responds to the board. She doesn't have voters. She has her own job. She wants to protect the company. But that's not up to her. To freeze those assets, unfreeze those assets, these are government's decisions, and I think we should talk to the governments. And the same, I think, applies to ECB. And there are many more things that the ECB can do and should do to build euro into global reserve currency. And this is not a make or break decision regarding expropriation of Russian assets. Yes, every time you weaponize your currency, people look for an alternative, being in yuan with yuan's problems, being it stable coins with stable coins problems, gold. The number of alternatives is actually limited. But every time you expropriate somebody else, trust in your currency goes down. But is that the first order issue for Europe today? It is an important issue for ECB, but Europe is not run by ECB.
So in the moment for you for the dollar, but Sergei, if I can, I mean, just do I interpret your response correctly as saying it's not really the ECB's fault? They're just doing what they should be doing. It's not Euroclear's fault and Belgium's fault. It should be governments, but then, you know, governments are also not in agreement. So isn't that just a recipe for saying we don't do anything?
No, I think it's a recipe. I think it's a recipe for saying governments, you should do something, because as Yuri said, Europe's security and therefore sovereignty is threatened. And one of the things that people don't realize about sovereignty is Putin doesn't need to invade Europe, but if Europe understands that he can, suddenly you start listening to Putin more than you want to, right? The same is when Putin is talking about Ukraine. Ukraine should limit its army to whatever, 100,000 soldiers. What that means that whenever Putin calls the Ukrainian president needs to pick up the phone and listen to Putin, because Putin has shown he can invade neighbors. So Ukrainian president will say, sure, we only have 100,000 soldiers. We've seen that Europe and America are not necessarily going to help us. I need to listen to what Russian president asks me to do. And so sovereignty is lost once you don't have power to stand up to this. And I think Europeans need to wake up to this. Europe is forged in crisis, as Jean Monnet has said. This is a crisis, and I think we need to communicate to each other that once you have a crisis, we need to do more.
Okay, so Paula, so I have just to start, I've long been trying to raise awareness of the different international roles of currencies and the consequences of each of those international roles. So it's not only the use of a currency in foreign exchange reserves, it's also kind of its role in monetary policy, its role in invoicing, which gives you price rigidities and insulation or exposure to different kinds of shocks. It's very broad in payment system. And that also gives you some power to use things like financial sanctions and to have effects of those types of tools, and it gives you trade-offs too with spillovers of whatever you're doing, for the rest of the world. So I think these are very, very important issues. I disagree with Sergei's statement that the dollar is already losing its role.
The share is coming down, no?
No. So among the indicators that you would cite of dollar use, the one that is cited, I think, is the share of the dollar in COFR statistics, so the IMF reserves. I actually disagree with one of the Eichen Green et al. Papers, which argues that that is broadly about trend diversification away from the dollar. That decline in COFR, it has been a trend decline over time. And by the way, a decline in the share of the dollar can happen for lots of different reasons, and they're not all kind of diminished impact or kind of negative ones, as liquidity of other currencies can increase, and that could help. In terms of the COFR statistics, part of the decline that we saw from 2015 to 2020, 2021 is divided into two categories of effects. One is an accumulation of reserves by countries that had lower than average shares of dollars in their portfolios. So think, for example, Switzerland accumulating 500 billion of reserves over that time, where their dollar shares typically 33% as opposed to 65% for many other countries. So that contributes a piece of it. Another piece of it is concentrated in, there are, among all the other countries, there are ones who increase dollar share and others that decrease dollar share. So it's not a broad-based trend, but the big grouping does look like it's a combination of maybe China, India, Russia declines. So that's not kind of a broad base. That's more of a maybe the fragmentation kind of story. So in terms of things that are potential consequences, when you think of sanctions, when you think of freezing of assets, over time, these events have spurred countries to invest more in their own payment systems. And so that kind of payment system, there's been a lot of declarations, but it's on the payment system side where I think there's something that's more concrete. You're not seeing a widespread adoption of those systems outside of their own countries or outside of very localized transaction activity, for example, China, Hong Kong type, or Russia with its immediate vicinity. But I think the payment system is one thing to keep an eye on. In terms of other fragmentation that we're seeing, and it's not really international roles of the dollar, it's just on kind of payments flows. So yeah, there's changing patterns of foreign direct investment. But on things like portfolio investment, bond holdings, I think what you're seeing more of is, for example, there was just the Geneva report just came out, and there's something in there about more use of offshore financial centers, for example, the Cayman Islands and others by China, for example. So it's not the total amount of assets that are invested in the US or in Europe that's changing, but the paths to those investments are changing. So I don't think we're seeing these declines yet, but I think in the dollar role, I agree that the liquidity issue on European markets, would be something that people thought a lot about. when the euro was first launched and when things flattened out, that's been kind of an argument ever since for expanding that liquidity. But so far, I think we're more status quo than not on this, with maybe some efforts to maintain own payment systems, to invest in ways that are outside the reach of financial sanctions, but still putting the assets where they had previously been.
Yeah, thank you, Linda. We had this discussion online as recently as yesterday, because the Geneva report, in fact, is about which was published very recently, is about financial fragmentation and question how much can we already see and how much do we forecast. Those two things are quite answered quite differently right now. Mauro and Alberto.
Yeah, discussion about reserve currencies and their global roles is fascinating, but I think it's really a detour from the real issue. I think the ECB's position is really about monetary financing. Making the euro a global currency is not part of the ECB's mandate. Avoiding monetary financing for fiscal issues is a central part of its mandate. And, fundamentally backstopping Euroclear is a fiscal issue which should be handled by fiscal authorities. Fiscal authorities who have difficulty making hard decisions always turn to the central bank to bail them out. That's always a recipe for inflation. And I think the ECB has taken a principled stance. It's really up to the governments to find a solution.
I wanted to go back a little bit to the topic of sanctions, which was mentioned at the beginning. What have we learned in these 4 years from the effectiveness of these sanctions? I don't follow very closely, but many of us had the impression at the beginning that this battery of sanctions would really cripple the Russian economy. It's apparent that that has not happened. And as Yuri had mentioned, not only that, they're still able to spend quite a bit of resources on the war. So what has failed? Is it just that we failed to rally other countries and so they have plenty of partners, or I don't know, were they less effective than we thought? I would like to hear your views on that. Thanks.
We have collected. I'd like to add one myself. I think that's mostly for Sergei and Yuri. On the fragmentation issue, not so much about financial fragmentation, but fragmentation within Europe. I mean, if I put together the story that Catherine told us, originally the inflation in Europe is mostly caused by the Russian invasion. It has basically made in Russia as a footnote, and it has had scarring effects, both in terms of economics, but also in terms of polities. Political polarization is much, much higher than it was at the time when the Russia invasion happened. And the rise of those forces that may be more Russia friendly also seem to be it seems to be a process which is kind of associated with that. So my question, the two of you, is Russia winning in Europe by other means? And if so, what should be done? But the other two questions, actually the Mauro was more of a statement in terms of what the ECB should stand, whoever wants to answer.
I mean, I could just come to the sanctions question and then call on Oleg and Alina to jump in on this too. There's that's why I put up that slide with the research that's being done. And at least in terms of, so remember I said that there are these targeted sanctions that are more at individuals and for political pressure. I don't have a comment on the effectiveness of those sanctions. But in terms of the trade and financial and oil sanctions, I think for maximum impact of anything like that, you have to have broad participation in the sanctions and enforcement of the sanctions. And so, for example, Beata Javorchik has a series of papers with co-authors that shows which countries are now trading in goods that they don't even produce. So really, in the perimeter of Russia, which ones have now taken a role as kind of a gateway for sanctions avoidance. Her work has pointed to Turkey, India, China. I believe your work as well, maybe you could comment, has added countries like Singapore and others on oil and petroleum products. But there are costs in the sense of the evidence that Russia is earning less on its exports and paying more for its imports, but that the volumes haven't responded to a degree that one might have in designing the sanctions hoped for. But let me throw that back to both of you to comment on for the petroleum side. If we...
Sure. Why don't you go? Both have the tags up.
Oh yeah, then they were $80 a barrel for a long time, and now they're coming down to 60. But 60 is still much above 45. At 60, Russian budget is no longer breaking even anymore, right? And so all the sanctions, you can quantify them in how much of percent of revenues they eaten away, right? And they've eaten away 10 or 20%. But when you start from a place where you're twice above the break-even price, right? I mean, you're only making a small dent. Not to say that that dent doesn't matter. Every dollar counts, but you're far away from a breaking point. Yeah.
Very quickly.
So just carrying on from that, Russia made the current account surplus historical high of 240 billion in 2022. So you give me a commodity exporter like Russia and say it's having a massive positive terms of trade shock. What's going to happen? Well, yes, there is come to compliance uncertainty and other kinds of uncertainty. But we, with one hand, would try to take away, but with the other, we actually gave a massive positive shock. So therefore, they did somewhat better, right? They put that money to good use. While we were discussing, they continued to export oil at the same level. So then another one announcing sanctions and not enforcing them does quote nothing apart from the political impression. And I don't know if those who have any interest in export controls, they should listen to the testimonies in Congress. And you should also watch Thank You for Smoking, because it goes wonderfully together. Because all of the top US companies, they just completely ignore this export controls. And we haven't seen a single enforcement announcement that would be meaningful to go after these companies like we have seen with the financial industry. And then brings me to the third point, that the only thing that, and Linda was talking about, that really works from the US is this threat of secondary sanctions, not secondary tariffs, whatever that nonsense we heard over the summer. It's actually secondary sanctions, because US invested since 9/11 into anti-money laundering, FATFA, international cooperation on the topic. And this way they finally had a grip on financial institution plumbing and the networks and access to payment systems. And I think this is the most under-researched area, because the payments experts are usually not the ones who talk about the role of the dollar, and they don't necessarily talk together, but we're absent. I think Linda was one of the sort of few papers that actually has it a little bit in there together, because that's the only way they can switch off the taps or threaten to switch off the taps. And the fact that since the beginning of the year, US has stopped threatening, we have China investing in Russian drone producers, and we have actually a little bit more comfortable trade going, because China is a little bit less afraid of the secondary sanctions. And the final one, yes, CBRD, and recently Buffett has done great work on the costs. Basically that, sometimes 2-3 times that Russia is overpaying, and the lead times have increasingly, I don't know, it's now I don't know, 45 days plus, for products that used to receive much easier. So yes, there is some impact, but there are caveats and you need to make an effort.
Sorry, I forgot to mention, and positive terms of trade shock is a very good way of thinking about it. All the sanctions happen together with a very large positive terms of trade shock. But one thing to keep in mind is, like, if you ask what the sanctions were particularly successful at, and I thought you're going to say about it, guess what's been most stable, right? Like the quantity of oil exported to the world market from Russia remained exactly flat over the last 4 years. So it's what, $8 million barrels a day. It's remarkably flat. There's been a massive substitution. So 55% of that went to Europe. Now 55 goes to China. Another 30 goes to India. So there was massive substitution, but the total quantity remained absolutely flat. So you have a positive terms of trade shock and no change in the quantities. And so maybe 25 or 26 will be a year when that starts to change. But, it's been 4 years of very high quantities and high prices as well.
But they have to take discount.
Yeah, discount is $7 a barrel right now, right? So discount, we're talking about percentages. So you make a dent of 10% or, overall.
This not a bug, but a feature, right? The whole idea of oil price cap was to keep Russian oil on the market because there was this risk that if you remove a major part of Russian exports from the market, the price will go up so much the total intake of petrodollars for Russia will actually be better. And this is what we saw in 2022 when, Oleg and I actually wrote op-eds in German media about this, that you need to introduce embargo as soon as possible. What we got instead, we got embargo announced. We had oil sanctions announced in May, June 2022, with the effect coming them into effect in the end of 2022 and beginning of 2023. So the whole 2022 was the year when oil prices anticipating the sanctions went up, but sanctions were actually not yet introduced. And that was this influx of petrodollars. And so Western governments said, probably when we think about oil price cap policy, we want Russia to export as much, but through the threat of secondary sanctions, we want to make sure that Russia gets only whatever $60 per barrel. So that was the idea of the sanctions. And now, as Elena completely correctly said, India doesn't know what to do because in 2023 and 2024, America told India, please buy Russian oil at oil price cap. Now Trump says, don't buy Russian oil. And India cannot really figure out which message is correct and whether the new message in 2026 will, again, 180 degrees difference. So yeah, it's on your question, Beatrice. I think, yes, it's a huge risk that Russia is winning in Europe by other means. A lot of people are asking the question why we have drones in European airports. It looks like the right message from Putin could be, I'm not going to invade Europe, I'm a nice guy, let's negotiate. But this message, sending drones, running sabotage operations, disinformation attacks, and so on, this message also is, please pay attention to what's happening in your backyard, invest in your own air defense. Before giving weapons to Ukraine, think about your own airports, and so on and so forth. And I think this is the message which is very, very clear. And supporting pro-Putin parties is also going in the same direction, saying, look, you almost lost the election here, here, and here, and I'll do more. So people who support Putin are saying, look, maybe we should not have him as an enemy. And so I think this is a very consistent operation and investment from Russia to undermine European unity and trying to send a message that when you mess up with Russia, you'll have inflation going up, living standards going down, so don't do it. And once again, this is the narrative, right? In 2022, all friends of Putin said, we are not friends with Putin anymore. He's not a good guy anymore. Berlusconi said, the Putin that I knew is no longer there, right? Berlusconi is no longer with us, but the narrative is still there. The narrative is, Putin is not nice, but we should not introduce sanctions. We should not send weapons because it's bad for us and there is no cost for Putin. So this narrative about no impact of sanctions is also part of this narrative. Why? Because if sanctions only hurt us and have no cost for Putin, then they're useless. But when you think about the impact of sanctions, as Oleg said, every dollar matters. It's harder for Putin to recruit soldiers. It's harder for Putin to produce weapons. And the way we should evaluate impact of sanctions, like those papers do, like they actually do, is compare them to a counterfactual. Let's assume that we live in the world where no export controls, no oil sanctions, Russia has not lost access to frozen assets. This is a very different world. In this world, the war probably would have already ended in 2022 with a very different outcome. So I think sanctions have had an effect, but indeed it would be unrealistic to think, as Oleg said, that they would cripple Putin's economy.
Just to echo what Sergei said, ideally what we need to have is a counterfactual, how Russia would look like if we didn't have sanctions. And it's very clear it will have a lot more money, much more in terms of resources, access to technology, and the outcome would be, I don't want to make a forecast here, but it would potentially look very different. And in terms of, measures other than military that divide Europe and so on, when I listened to Catherine's presentation, I saw it should have a subtitle, which is "From Russia with Love." I don't want to talk about, corruption when you buy politicians. I want to talk about Trump, Salvini, or Le Pen. This is kind of a completely different ball game. But inflation is a big factor in political elections. One prominent theory why Trump was elected in the US was that, prices increased too much, inflation was too high. He was promising to reduce the level of prices, and he keeps saying that actually it's lower level prices now, which is not true. But the narrative was that, this inflation is a big problem. We have to do something about this. The current politicians cannot cope with this issue. We have to find a fresh guy, somebody who's outside the system and can fix this problem for us. But obviously it results in dysfunction because these guys are populists. They don't know what they're doing, and they can have a 7% deficit or 10% deficit. We'll see how far we can go.
Just say one more thing, since I'm doing research on populism, there is a very good paper by Stefanie Stancheva exactly on this issue, how people think about inflation, what it does to their view of the world. So inflation is really great for populists. We have forgotten about this because we've not seen major episodes of inflation for a while, for the reason that was mentioned by Yuri. You come to a mainstream politician and you say, I'm very unhappy about this inflation episode. This politician says, why are you unhappy? We fought against inflation. Inflation's coming down. Central banks, not in the UK, but central banks in many countries have brought inflation down to the target, right? And people say, what? I'm talking about price level.
Yeah.
You're talking about price change rate. You're a central banker who's never been to a grocery store, right? You don't know how we ordinary people live. Now, the finance minister stands up and says, but your wage has caught up with inflation. And indeed, you look at the US, for example, wages pretty much caught up with inflation. But then ordinary people would say, but this is because I worked hard, right? I deserve this wage increase. And the fact that my wage caught up with inflation, my real wage is roughly where it used to be, is because I work harder, I exercise more time and effort in my job. And Stefanie Stancheva actually shows that majority of people believe exactly this.
Now unless, miraculously I get a half an hour again. We are actually in the 3-minute. So Tito and Charles, do you want to?
Perhaps a question also for the next presentation. We are talking about the effectiveness of sanction by looking only at the export side, it seems to me, while my impression is that the real role of sanction is one of hitting imports of Russia, especially on technology, on military equipment. So that should be the way we should look at the impact of sanction more than at the export side. So I wonder whether this is something we can discuss. And one thing on the corruption, I think there has been a tremendous progress in research about corruption. There are methods that have been developed, and these things have been investigated in many countries in detail. I think that this type of expertise should be used to document what, I mean, if possible to get any type of data on what's happening in the Ukraine would be very important.
Okay,
So Ukrainian, yeah.
2 minutes, briefly, Joe.
Yeah, just coming too late with a question. I wanted to ask, what is the economic situation in Russia? Because we talk about sanction. They have a booming economy because the war is a big Keynesian push. They have no unemployment. They don't import much because of sanctions. So all of that means reduce domestic consumption, which is hurting the consumer. And inflation, because a lot of supply is military. At the same time, wars are known to push innovation. So they build up all these industries to produce weapons, and they apparently in technology they are closely on the footsteps of Ukraine. So is this a good thing or a bad thing?
Yes, for this, because I am Swiss here, but we still have a full day, right? Which is going to be about future of Ukraine. We will have papers, but we have also opportunities to interact outside the narrow thing of the narrow space of the papers themselves. Clearly, this is an incredibly important question. What is the state of Russia? But also it is an important question, and I want to do some advertising. We just published the second edition of the book on the economic consequences of the second Trump administration, which has chapters about US, it has chapters also about Europe, and they mostly deal with defense, and they mostly deal with the question, what is next and what is the future of Europe? So, you know, this we should, if one thing I would like to posit is that we cannot see Ukraine in isolation. Ukraine and Europe and their future are intimately linked. And if Europe falls apart, if Europe actually is, if the scramble for Europe is successful across different influence, and the US is clearly not a friend of Europe right now anymore. At least not at the moment, and therefore, what Europe can or cannot do is going to be a very important part of the answer to what is the future for Ukraine and for Europe. So I will finish it here and directly hand over to the next. There is, I think, no break, right?
Yes, thank you again for the panel. Okay, so you are chairing this session. Let's organize ourselves and get some coffee. Thank you.
Oh, great. We exchanged emails all the time. 30 minutes, that's what I was looking for. And when do we start? I just yeah, sorry for saying Yes, I'm not going to say you. I think some people say you're the only one who can talk as a maybe masters of communication.
Can we start settling in, please? For them, I think. If you can take your seats. Yes, please. We will start the next panel. Oleg will present, and then the discussants are here. Maybe we shift in this direction so you can see. Oleg, you have half an hour to present, please.
Thank you very much. Very honored to be here. It's work with Dima. Dima is here as well. And this is my motivating question. It's actually a big open question, which I'm not going to be able to quite answer in this paper, but I think that's the important question that relates to what Alberto was asking before that we just debated. And the question is the following: given this barrage of financial and trade sanctions that were imposed on Russia very quickly, very swiftly, clearly came as a surprise early on. They did move the market, but why did they fail to achieve the kind of the quick goal of a financial crisis, right? And so there are two ways of answering that. One is to say, well, perhaps the sanctions were insufficient, or the mix of sanctions was suboptimal. And kind of like the sanctions that we put together didn't work particularly well. So when you sanction the financial side of things and you limit imports, this just doesn't work as well as if you combine that with exports. And that's kind of like a possible hypothesis. But the alternative hypothesis is just maybe there was nothing that the Western countries could have done, because there was this thing which is called financial fortress Russia. I'm actually not sure who coined the term. Maybe Elena coined. Yes, that's what I thought. And so the idea is that given sort of the state of the economy with which Russia came to the beginning of the war, right? The fact that there were this large fiscal surpluses, large trade surpluses, given current levels of oil prices, it was not even close to those margins. It was sort of very large reserves, and they were diversified. So in preparation for the war, they were diversified quite a bit, and so it was only possible to sanction a fraction of the reserves. What's also important, there was little dollarization of the domestic financial market, right? So one thing that oftentimes happens in developing countries or emerging markets is that the domestic market is dollarized, and perhaps sanctions are more potent under those circumstances. But the Russian economy by 2022 was not dollarized. And of course, there was a very extensive kind of administrative control over the economy, right? And given those circumstances, it's actually not obvious that there was a particular combination of sanctions that could have tipped Russia into a full-scale crisis, right? Of course, very importantly, it required that it also requires that given all those fundamentals, there could have been policy blunders, right? And so Russia did lots of policies in response to sanctions, and the question is, were those policies helpful or they were mostly distortionary? And so what our paper is about is a particular type of policies that were used, type of financial repression policies, and in particular financial repressions in the currency market. And so the question is are these policies helpful? Do we expect them to be coming around generically under sanctions or under other circumstances? So that's what this paper is about, right? But what's important to keep in mind is, and quite amazingly, it's the end of the third year of the war, right? And so we're still debating whether there is a military solution to it or economic solution, right? And the hope is that there is an economic solution which is viewed less costly than military, right? But it might well be the case that certain things don't have economic solutions. That's a hypothesis to keep in mind, right? And this is what Rick Mishkin said when he discussed our paper with Elena at Brookings, right? And so I'm not going to quite give an answer to this, whether there exists an economic solution, but it's kind of obviously a very important big question that remains open. We're going to have sort of a narrow thing that we're going to do in this paper. And so we sort of shift into the world where tariffs are becoming a commonplace, sanctions are becoming commonplace, like lots of other things are changing. We're going to a much more fragmented world. And so there is a clear shift in the policy discussion away from sort of neoclassical principles of not distorting markets. And a lot of things that were viewed as sort of like not welcome as policy interventions are becoming a commonplace. And this includes capital controls, FX interventions, and perhaps the lesser studied topic, which gaining more interest right now, is the topic of financial repression, right? And in a way, financial repression is coming back around the world, amazingly coming back in both emerging markets, but also in advanced economies, right? And so we've lived in the world with a lot of financial repressions before, then we have a couple of decades when it receded, but now it's probably coming back. And so the question is sort of like, what do financial repressions do? It's a broad set of policies. What those policies are, we're going to focus on a specific one that focuses on the currency market. Sort of like, what's a case use? When can you use financial repression? When you cannot? Sort of like, is in general, once you do it, how does it propagate through the economy? So that's sort of the narrow focus of our paper today. And the case use, we start by reviewing different definitions of financial repressions, how they've been used around the world. But then the case in point is the set of policies that Russia responded with to the sanctions imposed in 22, right? And it actually gives a lot of information for us to learn how these policies work. So the narrow view of financial repression is all sorts of things that the governments do to force domestic savers, and in particular the banking system, to hold government debt. And the focus is on kind of helping with the fiscal problems, right? Alleviating the fiscal constraints, creating fiscal space for the government, reducing the cost of borrowing. So this is how typically, in a narrow way, financial repressions are viewed. But in many countries, financial repressions are used in other markets other than sovereign debt markets. Currency market is one of the markets where they can be used. But oftentimes, financial repression sort of targeted at consumption or savings decision. And so their goal could be the currency market, the current account, right? And so this is just a broad set of sort of financially repressive policies that can affect different margins, and the outcomes of interest are definitely the fiscal position of a country, the current account or trade deficit positions of the country, and what happens with the exchange rate, right? And typically, whenever you use such policy, it will affect all margins. We're going to focus on the ones that are used in the currency market, but they will have implications for the fiscal position of the government and for the trade balance of the government, for the trade balance of the country as well. Okay. So I'm not going to go through the review of policies, but financial repressions has been pretty ubiquitously used in different places, and situations when they're not used are rather exceptions. And so the last 20 years in 2000s and 2010s were more of sort of unusual situations where there was less financial repression used around the world. And so financial repression is arguably making it come back. given the increase in government debt levels around the world. So this year's Mandel Flemin lecture at the IMF a couple of weeks ago was by Ricardo Reis, and it was exactly on the topic of financial repression. So this is things that are coming back. So what we're gonna do, we've developed in our previous work an analytical framework, and it turns out to be quite suitable for studying financial repressions in the currency market. So that's gonna be our focus here. So we're gonna look at an open economy. There are some nominal rigidities in there, and this is sort of a conventional target for monetary policy. But importantly, there's going to be a segmented currency market. And so in general, there is good reasons to believe that currency markets are somewhat segmented in the sense that supply of currencies is not perfectly elastic. But once you have an economy under sanctions, it's actually a particularly segmented market, right? And so this would be our focus. I'm going to show how we model that situation. And so we will think of the households of the domestic savers as drawing utility from foreign currency savings, from savings in foreign currency in the domestic market. And so they will be a source of demand for foreign currency, right, in the economy. Okay. So this is the structure of the economy. So the households are conventional in everything, but the unconventional piece of the model is that the household have utility from real foreign currency balances, right? So they want to hold foreign currency as a vehicle for saving, and this is the price index of imports. So the idea is that in the future you might need foreign currency to buy imports, and you want to store some amount of foreign currency in that case. And here's the shock, and the shock drives it when it goes up, it increases the demand for foreign currency deposits held by the household. The households can also save in the domestic currency, bonds or deposits, but those don't have those liquidity or convenience services that the foreign currency deposits have. So importantly, this would be the interest rate for foreign currency that's specific to the domestic market. And so what the segmented market does, it breaks the equality between the domestic interest rates on foreign currency from the world interest rate R-star, right? And the government will have a control over that gap. So the measures of financial repression will introduce a wedge between essentially the price of currency in the domestic market and in the international market. There's not going to be a perfectly elastic supply, right? And so this gives, the segmentation of the currency market gives the government an additional policy tool to use. And so the question is, how useful is that policy tool, right? And so this is the budget constraint of the government. So this is the net foreign asset position of the country. These are the foreign assets held by the private, and the gap between the two is the official reserves, right? And then this is the domestic borrowing of the government, and this is the primary surplus of the government. And so you can think of government policies in two ways. It has official reserves that it can put on the market, or it can do measures of financial repression in the currency market. This is flipped. So it could suppress the rates of return that domestic savers will receive on their home currency deposits. And I'm going to talk, in the case of Russia, specifically about which policies have been used in the currency market. But the idea is that the realized return for those who save in foreign currency is suppressed by the government. And so there are two ways that the government can do it. If it has reserves, it can provide it to the domestic market when the public wants it. Alternatively, it can suppress the demand. And these are the two policy tools potentially at the disposal of the government. Okay, so it turns out that this model with the simple ingredients have a very kind of like nice characterization in these three equations. That's all you need to know. So there's going to be demand for imports. And so you need foreign currency to buy imports. So this is one source of demand for import. One source of demand for currency is the import demand schedule, right? The second source of demand for currency comes from the earlier equation for savings in foreign currency. And so there are two terms. There is a kind of like a consumption smoothing motive for imports. And then there is this demand to hold currency as a vehicle of saving. And the two, if currency is scarce, and this is kind of the unconventional part of the model, typically the currency is supplied fully elastically in a standard small open economy analysis, so you don't really even have to think about it. But once currency is supplied inelastically, and in particular this will happen in a situation when the country is cut off from the sort of world financial markets and so on, so sanctions kind of amplify that segmentation, then there is this competition for currency between those who are buying imports and those who want to save. And that's kind of going to be at the core of this model. And this equation kind of shows these two terms. These are these two competing terms why people might want to have currency domestically, right? And finally, the country needs to be subject to the country budget constraint. Whether it can or cannot borrow from the rest of the world is reflected here at R star, but these are the trade surpluses, right? And so if you cannot borrow from the rest of the world, then you have to run balanced trade, or you cannot run trade deficit, but that's what the budget constraint will tell you to. If you can borrow at a rate R star, then this is just can be converted into intertemporal budget constraint. So it turns out that the whole equilibrium will be interplay of these three equations, and I'm gonna walk you through a sequence of propositions that kind of just tell you what happens under different circumstances, but all of this can be sort of solved analytically from these three equations. So the first result is the implementability result, and what essentially it says is if you have financial repression, if you can control the rate of return that the domestic agents will perceive or get in the domestic market, and for example, what you can do, well, specific things that were done in Russia, there was a tax on buying foreign currency. There was a ban on withdrawals from foreign currency accounts. These are all repressive measures that kind of create a realized low return or low perceived return on holding foreign currency deposits domestically, right? And so the result is like this. If the government has this tool at its disposal, you can throw away this equation. So you can implement any allocation that satisfies the budget constraint and the import demand schedule. So these are like sort of the implementability constraint on the government, right? You can completely ignore the earlier equation because you have a tool to exactly affect it. And so as a result, if there is a shock, like a financial shock, when the public wants to hold more foreign currency, they kind of think of the domestic currency as being unsafe. They don't want to hold it. They want to switch to foreign currency. Well, the government can undo that shock with financial repression, and that's the implementability thing. That shock shows up in the earlier equation, but the earlier equation doesn't constrain the planner. The planner can undo it with financial repression. So this is kind of the first principle. So now we know that this can be done. The question is whether the government would want to do that. And we have these two results about optimal policies. The first one is not surprising, says that if you have a full set of tools, including FX reserves, unlimited FX reserves, you never want to do financial repression. And this is really like a Friedman rule. If the government has unlimited reserves, opportunity cost of these reserves is R star, the world interest rate, then the government should just provide these reserves to the public. And if the government can, in an unconstrained way, provide those reserves, then there is really no need for financial repression. The households will be getting the foreign currency at the opportunity cost of R star, basically. And that's kind of part of the first best. And the rest of the first best is standard. You use monetary policy, you use FX interventions, but you don't want to use financial repression. And that was not particularly surprising. Financial repression is a distortive tool. FX interventions strongly dominated. But what was really surprising to us is the second result, that imagine you don't have FX interventions. And the result is that you still don't want to use financial repression. It's strictly welfare reducing in any amount. So any amount of suppression of foreign currency demand from the perspective of savers is welfare reducing for the whole economy here under the representative agent. And what's the idea here? Well, there is a pecuniary externality. So savers, by hoarding dollars or euros, whatever it is, they beaten up the price of foreign currency. So the exchange rate depreciates. And so they kind of impose a sort of a pecuniary externality through this exchange rate on everybody else who is using those dollars to buy imports. But it's fully internalized. So equilibrium exchange rate exactly reflects the relative value of saving versus buying imports. And so if the household wants to save, it will be reflected in that price. And so exactly on the margin, there is no actual externality between savers and importers. And so you're not in the first best anymore. You don't have FXI to implement first best, but you don't want to intervene with financial repression from the perspective of a representative agent. And the question then is like, if this is the right model, why would you ever want to use financial repression? But this is kind of intriguing. So the next result is once you go to the world of heterogeneous agents, now there is a case for financial repression to be used. And so so financial repression turns out to be an instrument not for welfare improvements, but for redistribution. And there are two types of redistributions that we will consider. One is redistribution in a heterogeneous agent world between savers and consumers. So for that, we kind of build an economy where there is a subset of agents who have access to savings. And then there is a subset of agents who are pure hand to mouth, that they just consume their incomes. And then what financial repression does, it's really a tool of suppressing savers, alleviating the pressure on the exchange rate, and thus helping the consumers, because for them, the exchange rate directly affects the cost of buying imports. And so whenever you're in an economy where the government perceives different groups of agents with different preferences between consumption of imports and saving, there is this room for redistribution. And you can make a case that in a world where a majority of households are hand to mouth, a utilitarian planner might want to use this tool from a welfare perspective as well. But this requires inter-person comparisons. It's not a Pareto improvement, right? Okay. So next, two types of redistributions that we're going to consider is redistribution now from private agents to the government, right? And so can financial repression of the currency market be used as a fiscal tool? And so the answer is yes, in two different ways. So first is to the extent that you are segmented from the world and there is a downward slope in demand for currency and the government can provide that currency in different ways, right? There is a room to extract surplus. And this is a standard seniorage argument, right? So the Friedman rule says that you, from the perspective of welfare, you supply as much currency until there is no kind of surplus left in that market. But if you want to generate revenues for the government, you stop short of that. And you stop short of that, you create seniorage revenues, right? And so it turns out that the government cannot affect import consumption. Import consumption is pinned down by the budget constraint in the long run. Exchange rate, the real exchange rate now, is pinned down by the import demand schedule. So we use those two schedules that the government are the actual implementability conditions on the government. What the government can do, it can have monetary inflation and the nominal exchange rate will be drifting. But the real exchange rate is outside of control of the government in the long run. But what the government can do in this economy is it can extract seniorage revenues. And the way it works is like this, right? By doing financial repression or undersupplying the currency to the domestic market, this is the seniorage term. And this is the earlier equation written in steady state, which is a downward currency demand, right? So you're basically maximizing fiscal revenue subject to this demand equation. And what you get is that you do want to have financial repression, essentially suppressing the rate that the savers can get on foreign currency to generate government revenues. If that's the priority, you use this distortionary tool to do it. What's interesting and perhaps, well, I'm not sure how surprising it is, but it's important to emphasize, the more segmented is the market from the rest of the world, and the bigger is the demand for currency, the bigger room for financial repression. So in a way, this is one way in which segmented the private agents from the foreign financial markets can backfire because it gives more room for the government to extract resources from them. And this is something to be kept in mind, right? It doesn't necessarily invalidate the use of sanctions and segmentation, but this adds this considerations to have that actually, imposing more constraints and frictions on the country gives the government additional policy tools. That's like a general principle. If there are more frictions, there typically are more policy tools to use, and in particular, you can use them towards extracting revenues. How am I doing on time? Do I have a... Perfect. That's exactly what I need. So then there is a second type of redistribution between private sector and the government sector, which is not about the levels of income, but about the timing of income that the government can make. And so what I wrote here is a first order expansions for primary surplus of the government and for the consumer price inflation in the economy. And so it could be that in different periods of time, the bottleneck for the domestic government, sometimes it's inflation and sometimes it's fiscal revenues. And so what financial repression will let you do is will allow you to choose the timing of when you can increase the revenues without changing their net present value, but at the cost of generating more inflation in those periods. And so you can play around with financial repression. And how does that happen? Well, there are pieces that are outside of the control of the government. So these are like this exogenous shocks here and here. But the real exchange rate, you cannot affect its long run level on average, but you can manipulate the path of the exchange rate with financial repression. And so that, as a result, you can move around this thing without changing its mean and move around this thing without changing its mean. In particular, and this was particularly relevant in the case of Russia, this is actually kind of exactly what arguably has happened in the summer of 2022. It turned out that the exchange rate is too strong, and I'm going to go and talk a little bit more about that. And this was actually the period exactly when financial repression was relieved. There was less financial repression. And the fact that you kind of started with high levels of financial repression allows you to go to lower level of financial repression and depreciate the exchange rate. And by that, actually improving things for at the cost of perhaps extra inflation, relieving the pressures on fiscal position of the government, where the expenditures are mostly in rubles and revenues are largely in dollars. So depreciating the currency gives you, for a commodity exporter, gives like a extra degree of freedom in terms of fiscal position, right? And that's exactly actually what happened. Okay, so there is one more result. So there was the question during the previous discussion about like focus on import versus export sanctions, and we've discussed that in somewhat previous work. So it turns out that on the learner symmetry, you have the symmetry between import tariffs and export tariffs, or import sanctions and export sanctions. And in principle, you can achieve similar goals, but it's supported by differential movements in exchange rate. And the understudied part of this analysis is, I mean, it's fairly standard thing in economics, the debt overhang types of issues. But where the exchange rate becomes allocative, the nominal exchange rate becomes allocative, right? Not the terms of trade that are targeted by sanctions and tariffs, but the exchange rate, if you have issues with debt and part of the debt is denominated in foreign currency. This was not the case for Russia, as I discussed, because there was little debt in foreign currency. Actually, it was largely de-dollarized economy. But for countries that are heavily dollarized, you really care about actually the exchange rate that multiplies foreign exchange, foreign debts inside the economy. So it's not about external debts, it's about domestic debts if they're denominated in foreign currencies. And what financial repression gives the government is the possibility of delaying this debt overhang problem by temporarily keeping exchange from depreciating, right? And so this is actually, with not making a lot of progress, we're just setting this up, that if you're in a world like that, financial repression gives you a temporary relief, not a permanent relief, because the long-run value of real exchange rate is pinned down by the budget constraint of the country nonetheless, but temporarily it gives you a relief. And the question is whether that's relief enough to delay the debt restructuring problems enough that you avoid the bank run or a financial crisis, right? And so this is kind of an interesting theoretical question, not particularly relevant for the case of Russia in 2022, exactly because the foreign debt was small, but in many other circumstances would be important. So this is the last part of the paper where I want to talk about different shocks that happened to Russian economy. Like most of them are sanctions, but a lot of them were like, financial consequences of sanctions and war as well. And then I want to talk through the timeline of financial repression policies, right? And how they fit into sort of this analytical way of thinking about that. So the black line is actually the realized exchange rate that happened in the data, and our model perfectly replicates it. So the three-equation model that I showed you, if we calibrate it to the import sanctions, to the export revenues, to monetary policy by matching inflation series in the data and other observables, we can fully match the exchange rate, right? We perfectly target it. And so what happened with the exchange rate is like immediately on impact, it depreciated by about 50%. Right? Or no, less than 50%, 40, 50%. So there was a very sharp depreciation on impact of the beginning of the war, announcement of sanctions, and everything that happened in the first weeks. There was this massive depreciation. It was not actually obvious whether that depreciation would stop. But then it stopped quite abruptly. And what surprised everybody is how much ruble appreciated afterwards. And so over the next couple of weeks, ruble started appreciating until it actually appreciated 20, 30% above the pre-war level, which was a big surprise, right? And then there was a trend for a year and a half of depreciation after that, and then it was stabilized. So this is kind of like a brief history of ruble exchange rate since 22. So what our model allows us to do is back out what were the forces behind that, right? And so what you see in the first months, it's blue is the financial shock. And I'll talk a little more of what that financial shock is. It was lean against with the purple, which is the FX intervention. So there were quite a lot of FX interventions from the unfrozen part of assets, and they lean against it, but they couldn't contain it quite in the first weeks, right? And it resulted in this massive depreciation. But what you see happening right away, and this is actually quite remarkable, are the trade things. So yellow and red, or yellow and orange, are the trade things. So yellow comes from exports. And this was a positive terms of trade shock, as we discussed before. So revenues were coming in at like record levels per month. What's amazing is over the first year, this extra revenues completely compensated the frozen assets. So they were exactly the same in magnitude as the frozen assets in the first day, right? And so what's interesting, the frozen assets, you kind of take the NPV of that, it affects kind of the economy in every period from today into the future. It makes economy poorer, but because you kind of take kind of the NPV of it and you convert it into the flow value, those flow values are not such a large impact on the economy, right? So that was about kind of like a 5% movement on exchange rate would have been done by the frozen reserves. But amazingly, the other thing that happened is that the collapse in imports, and imports really did collapse. And so what that did, it eliminated the need for foreign currency. So if you cannot buy imports because you're constrained, like nobody is selling you goods, you actually don't need foreign currency, right? Like even if you had that foreign currency, there is not much that you can do. And so in the first months of the war, this combination of focusing on imports and big positive terms of trade shock on the export side, they worked in the same direction of appreciating the ruble, right? And so over time, gradually, the financial forces waned, the trade forces waned. And so when basically the other amazing thing is by fall 2022, the imports fully recovered. So all of that work on doing import sanctions, it lasted about 4 months. After those 4 months, they were pretty much completely rerouted, that in total values, they were not below the pre-war levels in the fall of 2022. What started happening then, the export revenue started declining, largely driven by the decline in world oil prices, but to some extent also driven by sanctions and the price cap and the European embargo and the discount that existed. And so in some work with Elena, we kind of do the decomposition of different contributions to this, right? And you can kind of calculate how much of the export revenues was chipped away through these different channels. And so what you see started happening, the ruble started, it had this persistent depreciation for about a year under those forces. And then it became politically important for the government to stabilize it at the level of 100 rubles a dollar. And so since then, it stayed below 100 rubles a dollar, right? And so this is sort of the history, like it's just a psychological barrier that they wanted to keep. And so I will end with this. So this is basically the timeline of the actual things that were done with financial repression. So right after the war starts and financial sanctions are announced, there is just as many sanctions were announced, there were as many policy responses basically from the Russian government. It's quite remarkable how many things were done in those 2 weeks. It's hard to kind of say exactly what was the contribution of individual policies, but essentially the full range of financial repression was used. The exporters had to sell revenues right away. It was not possible to withdraw from foreign currency deposits for households. It was very difficult to expatriate money abroad. So whenever the assets were sold in Russia and companies tried to take it out, there were a lot of barriers to capital outflows. Many businesses were not allowed to be sold. And so all of these measures were taken over basically 1 or 2 weeks, including an increase in the policy rate from 9.5% to 20%. And this basically all happened overnight. And so the big question was any of this thing pivotal in curbing the financial crisis? And the financial crisis would have kind of unraveled without one of this. And so this is kind of the experiment that we don't have. One thing I want to show you how kind of effective those measures were. And this is something that we found surprising in the data. So they went with a 12% tax to buy currency. So if you wanted to buy dollars, euros, or British pound, you had to pay 12% of the value of how much you're buying as a tax to the government. But it was not imposed on Swiss francs because Swiss francs were just too small. And so what happened during the period when the tax exists, the domestic exchange rate between Swiss francs and dollars moved relative to world exchange rate between Swiss francs and dollars. So it really showed that the currency markets was segmented. Otherwise, there would have been a pure, static arbitrage to do. And it kind of moved exactly by the level of the tax. So it sort of like remarkably shows that these markets are inelastic. There is demand for that. And the rates of return exactly reflect the measures of financial repression. And so what you've also seen is people started shifting to using Swiss francs, obviously. So this is a relative turnover of Swiss francs relative to dollars. And it just went up by multiple log points during this period. Okay, I mentioned already, so I go very quickly. So, once the money from trade started flowing in, dollars stopped being scarce. So euros stopped being scarce very quickly in the domestic market. And this was the period when essentially most of financial repression measures were relaxed. because the government was really now concerned about ruble being too strong, which was bad for fiscal reasons, right? And so they kind of used the relaxation of financial repression to get ruble to a more desirable level from the point of view of the fiscal position. But once export revenue started to decline, sort of towards the end of 2022, then financial repression was brought back. And then it was brought back gradually in different steps. It was not required to be brought in such a crude way like in the beginning when everything was used. And so then they were just playing around with different measures of financial repression, and they realized that the one that was particularly potent at stabilizing the ruble is forcing exporters to sell currency back to the government. And so it reached like the levels that exporters had to sell 95% of their export revenues. And that's what allowed to stabilize the ruble. One important thing to keep in mind, Russia, even though fiscally Russia is in deficit this year, but trade surplus is still there, right? So it's still a country running a significant trade surplus, right? So the oil prices are not low enough yet to tip it into a trade deficit. Okay, so let me summarize with this. In normal times, it looks like, at least if we have the right model of financial repression, it shouldn't be used. In normal times, there are other tools that strictly dominate the use of financial repression. However, there are many case uses for financial repression, and they tend to have to do with redistribution. It could be redistribution between different types of agents, private agents in the economy, or perhaps more importantly, financial repression is used for redistribution from private sector to the government sector. What the big question that sort of stays open is the one from which I started is it a universal tool for countries that are under sanctions? And so segmented from the currency market, is it powerful enough tool to avoid currency crisis, right? Can you avoid any sort of currency crisis with that tool? Our model says yes, because you can implement anything in that earlier equation, but of course I wouldn't quite trust the model there. And so the question is under which circumstances, in which parts of a state space there are measures that foreign countries can impose that would lead to a full-scale financial and currency crisis, and when this cannot be done. And I think that's sort of an important question for thinking about what happened early in 2022. So,
thank you, Oleg. Very dynamic presentation. Yes, Alberto, please. Sorry, do you have slides or no slides?
Slides, yeah. Hopefully I do. Well, let me thank you first for inviting me to discuss the paper. Are they there? Yeah. So let me tell you that I learned quite a bit. It made me think. I've seen both Oleg and Dima present, close models to this one many times, but one thing is to listen to them in a conference, a difference trying to read and understand the paper for a discussion. So I learned quite a bit. Okay, so let me tell you what the paper is about. Oleg explained it very well. We live in a world where now trade sanctions, financial sanctions, tariffs, they're being routinely used. How do you react to these things? You could think about imposing capital controls, foreign exchange interventions, financial repression, and the paper asks, on the surface, a kind of simple question: should financial repression be used? If so, when? And if so, why? Okay. Now, what model do they use to answer this? They have a small open economy model that's based on their previous work. This is like a standard small open economy model, but it has three key ingredients. The first one, it's a bit of a sideshow for my discussion. There's tradable and non-tradable goods. In the non-tradable sector, there's price stickiness, and that gives a role for monetary policy. The second one is segmentation. So it's a model where agents cannot go and buy, let's say, dollar-denominated assets directly. They need to go through the government. And in fact, they have households and everyone else, banks, the governments, they're all lumped up together. They run the rest of the economy. And the last one is people value dollars. It's dollars in the utility function kind of model. On top of everything else it gives me, I kind of get a kick of having dollars. I'm from Argentina. This is a model of Argentines. We like dollars, extremely dollarized. And so we have something like this in our utility function. Okay. Now, the nice thing, which Oleg explained well, but I want to just rephrase that, is that you put all these things together and you can boil the model to three equations that really tell you all you need to know about this world, I think. They're the three ones that you see there. The top one is demand for import. So it tells you basically that the ratio of demand to imports to the domestic good, which the market has to clear, so it's equal to production, depends on relative prices. Those relative prices in turn depends on the exchange rate, that's the psi you see there. The second one is a country budget constraint. Once you put everyone together in this country, the rate at which the country accumulates reserves has to be equal to their surplus, foreign surplus, their production minus their imports. That's how we accumulate net foreign assets. And the last one is this intertemporal condition. Looks very complicated, but essentially households, how many dollars do they want to hold? And that has a kind of Euler component, tradable consumption today versus tomorrow. But then I have the psi here that drives everything. Okay, and the paper, the question asked in a nutshell, reducing it a little bit, is how should policy react to sanctions? But for most of the paper, it's a very specific interpretation of sanctions. It's the psi going up. Okay, that's in a way how you can start thinking about sanctions. So I wake up, people in my economy suddenly want to have a lot of dollars. Why is that? Well, maybe it's related to the war, to the sanctions, people become anxious, whatever. What should the government do? Okay, now there's 3 policies that the paper considers at length. So here's the same 3 equations. The first one I'm going to put here in magenta or whatever that color is, well, the government should sell reserves. Here, people want dollars. They cannot buy dollars directly, but if the government has a pile of dollars and it's costless, I just sell them to the households directly. Now, that doesn't show up in any of the equations. It's going to show up the households allowing them to respond to this increase in psi accumulating dollars, but it won't change the trade surplus, the asset, nothing. These dollars were already in the country. We give them to the households. Okay. Now, we may think, well, that's not very realistic because the government does not have these reserves to give them. So what else can we do? Well, basically 2 things. The first one is let the households accumulate these dollars. Okay. What would that mean? This would be essentially saying people want dollars, let them buy it. So where do I see that in the equations? You're going to see that's going to affect the top 2 equations. Basically, I want to accumulate more dollars. That's going to show up here. How do I accumulate that? We need a bigger trade surplus. So what's going to happen? Well, people are going to reduce their consumption of tradables in order to accumulate dollars. And how's the equilibrium going to adjust? Well, the exchange rate will depreciate. So this is what Oleg was explaining. People want dollars, let them have the dollars. In order to accumulate the dollars, they reduce their consumption of tradables, the exchange rate depreciates. Okay, very good. No problem with that. We need to adjust our consumption of tradables, and that's it. And the last one is the financial repression. Now, what's financial repression in this model? Think about it. And this is one of their main results is, look, financial repression is affecting the interest rate, the return that I get on my foreign savings. And if you look at these equations clearly, you can see, well, give me any F, Y, C, E, satisfy these 2 equations, plug the numbers here, and I'll find the R star that makes this equal to 1. Okay, so what this is saying in this story is, imagine psi goes up. One option would be let them buy the dollars and will depreciate. The other one is no, you know what? I won't let them buy the dollars. How won't I do that? I'll tax the hell out of their dollar holdings by really depressing the return on their dollars. These are basically the 2 options. Either I let the exchange rate depreciate and let them have the dollars, or I make it so unattractive for them that they won't have the dollars, even though they would love to have them. Okay? How do you rank these policies? This is like a representative agent framework. Well, it turns out the best policy, of course, if I'm sitting on a pile of reserves, is just to give them the reserves. This seems very natural. The second best, actually, is to let them buy the dollars and let's just depreciate. Okay? Now, why is that costless in this world? Well, Oleg kind of mentioned it, but I'm going to come back to that. Basically, there's no externalities, or there is an externality, but no frictions in the exchange rate market. So at the end, well, a depreciation depreciates. I consume a little bit less tradables, but I accumulate dollars, which is what I want. And financial repression turns out here to be the worst option. Why is that? Well, if we go back to the equations, it's a world where I'm desperate to hold dollars, but I'm simply taxing you. I'm not letting you adjust. Okay, that makes me very unhappy. Okay, then they extend the model and they say, well, there could be additional effects if you allow for heterogeneity. So they have this model, I call it here TOS. Everyone has Hank, Frank, whatever. I call it here TOS. This is a 2-agent with sanctions model. So you have hand-to-mouth guys who are not born with any tradable, and a depreciation really kills them. And then you want to prevent a depreciation. So you need a motive to prevent a depreciation. You need to make a depreciation costly. And they also look at whether repression is a source of government revenue. And finally, they apply the model to Russia. Okay, so it's in a nutshell what the paper does. So my discussion is I don't want to, quibble on formalities of the model. They worked a lot with this model. It seems, actually, I like the fact that you can reduce everything to 3 equations and use it to think. But I want to just mention 4 key messages that I think could be strengthened in the paper. Okay, the first one they did already in the last version that we got. You cannot see the title here, but it says, what is financial repression? Okay, so in the model, financial repression is a tax on foreign savings, on buying dollars. That's what it is. So it's essentially a capital control. Why would I want to use it? Well, it's unclear. I need to think once again that a depreciation is costly. As Oleg was mentioning, this is very different or quite different, maybe not so different under the surface from the traditional view of financial repression, which basically what we have in mind is, look, what is financial repression? We're going to keep interest rates, domestic interest rates low. We're going to create a captive mass of creditors domestically. So basically we push people into buying government debt, provide a cheap source of funding for the government. Okay, so it's really fiscal. And it's what, Reinhard, Spranzi, and others have shown, well, many Western governments used to bring down debt after World War II. Okay, the paper adopts what they call a broader view. Now, I have no problem with that in principle. In fact, you cannot think of financial repression without some form of capital controls, because if I depress your returns, I need to keep you from getting out. So they very naturally go hand in hand. But one question I have for the two of you is, what, if any, is the boundary between financial repression and capital or exchange rate controls? Imagine I don't want a depreciation like we do in Argentina, and so importers need a license to get the dollars. Would you call that financial repression? I don't know. Maybe you could differentiate it by the goal. Is it fiscal in nature? Then I think of repression. But in the paper, the fiscal aspect is a bit of a sideshow, I think, but maybe I'm wrong. Okay, so that's my first comment. I think for the reader, it would be very useful. You start reading financial repression, you expect something very different. The second one is, when is financial repression useful? I already discussed this. So in the baseline model, it's not part of the optimal toolkit, basically because there's no costly, let's say, externalities associated to the depreciation. Okay. In the standard view of financial repression, when you want to, there is an externality. People maybe don't internalize that by buying government debt, I prevent a costly default. I don't internalize the effect on debt enforcement. And so I need to, push people into buying the debt. Here, there is no such mechanism. Now, you could introduce it, and they do in some extensions. But one thing the way the paper is now structured is it has many subsections with extension. I would group them under a general heading, which I think would be better for the reader, saying, look, in a representative agent world, you don't want to use it. But once there's externalities coupled with frictions in the exchange rate market, anything that makes a devaluation costly, then you may want to use it in equilibrium. For instance, a very common one, once again being Argentine, is balance sheet mismatch in banks. Depreciation can bring banks under. That will be very costly for the economy. That's one case where I clearly would want to intervene maybe and prevent the depreciation. They have something like this in the paper with a heterogeneous agent extension and with one last extension that Oleg explained very quickly, where depreciation can be contractionary. But I think it would be better just conceptually to put all these extensions under that general heading for the conceptual discussion. Okay, so what is financial repression? When is it used? The third comment I have is, why is Russia a good lab to test this model? Okay, and it's not immediately obvious, but one way to interpret this world, and I want to go back to the beginning, is remember, sanctions are a psi shock, a very particular kind of shock. People want to hold dollars. And what Oleg and Dima show is, well, look at this. Actually, you can use financial repression to perfectly undo psi shocks. What does it mean? Well, give me any combination of tradable consumption, exchange rate, and net foreign asset that satisfies this import demand and government budget constraint. Put in any number that satisfies this equation, I'll take care of the last equation through financial repression. And what that means is that if the last equation is moving around, psi goes up, people want dollars, don't worry, I'll undo it. You don't need to change anything here. So we don't need a depreciation, we don't need an adjustment, etc. Okay. Now, one thing I kept coming back to while I was reading the paper is, well, many sanctions affect directly these two equations. Oleg alluded to this in his talk. Of course, what if I have export sanctions? Well, maybe this Y star here goes down. What if I have import sanctions? Maybe the CF goes down. Okay. Now, in that case, of course, you can still use financial repression, but you won't be able to undo the shock. You're going to have to live with some consequence of the shock, and then financial repression will be one more leg in this tool. So, in a sense, intuitively, what you come out of reading the model is, look, in a world where you have upside shock, financial repression might be more useful than in a world where all the sanctions come through import-export restrictions and you don't have upside shock. Now, did we have upside shock in the Russian case or not? And this is where their quantification exercise, you can frame it in a way that I think is more useful to the reader. You say, well, let's go to the Russian case. What do they do in the Russian case? Oleg showed this picture. Basically, what they do is go back to our three equations and plug in everything we can observe, the Fs, the CFs, what we cannot observe is the psi. So psi is a residual. You back it out to exactly get the exchange rate that you see in the data. Okay? And now, what I think is interesting is this makes the quantification exercise, I think, closer to a discussion. You can say, you know, if we saw no blue here, it would mean psi never moved. I don't think financial repression would be a very natural tool in that case. But what you see here is that at least initially, no. There was a huge financial shock. People were demanding a lot of dollars. So it looks a little bit like the exercise they have in the paper. So this at least tells you, well, the model kind of makes sense to think about this question. Yeah, I'm almost done. Now, one thing is when you back this out, you're backing out the psi together with financial repression because it's a residual. So at the end, you back out whatever the increase in demand for dollars was. So that per se cannot tell you whether financial repression was important, but it can tell you at least, well, the psi shock was there, we can think about it. Okay, and this leads me to my last comment. After you build up, you know, what is financial repression? When would it be important? Could you apply it to Russia, this model? Yes. What do we learn from this? And this is where I think the paper is a little bit, could be strengthened a little bit, okay? Because what do we learn? Well, one possible reading that you could come away is, well, financial repression did not play a major role, okay? Why? Well, Oleg showed us, yes, they took measures, constrained dollars, purchases, and so on. But this is a country at war, facing a bunch of sanctions, and they did this for 2 months. In Argentina, we've been doing this stuff for 20 years without wars or sanctions or whatever. So at the end of the day, I don't know how to interpret the findings. What should we conclude? Is the conclusion that financial repression was minimal? Maybe in light of the theory, you would think that's unsurprising, Oleg, depending on which world you live in, especially if you compare it with other crises like Russia 98. We have a lot of evidence that there was a lot of repression trying to induce banks to hold the bond before the default, etc. So I guess my last comment, and here I finish, I would strengthen a little bit the message. It's a bit anticlimactic to do the build-up and then finish up the paper without a clear verdict, even if you have to speculate. Thank you.
Thank you very much. Please, and the second discussant also with slides.
Pleasure being here. First edition of this we'll remember in many years to come. Okay, so this is great paper to read, really fun. So I'm going to try to do two things. Give you a little bit of an overview of financial repression, and my comments are going to be kind of related to Alberto. I mean, we haven't coordinated. And then mostly I'm going to focus. Most of my discussion is going to be. I have a stripped down version of their model, and understand more why financial repression doesn't work and why foreign exchange intervention do, and then conclude. Okay, so overview of financial repression. In general, I think the most general definition of financial repression is that every policies that distort financial decision of agents. That's the thing. Now, typically people think about, oh, okay, things on banks, you have to buy government bonds, but it could be any tax on assets. If I tax differentially one type of asset, it's a form of financial repression. It's the government trying to affect financial decision of people. Now, why do government do that? The general view and the old McKinnon and Shaw view was that they do that because they want to raise revenues. You know, they want to say, I'm going to force the interest rate to be low, force the banks to hold bonds, captive demand, lower rates on government bonds, I get more money. But in general, that's some broader view. It says, suppose there is, I don't do this financial repression, I have a certain equilibrium. Once I start putting these taxes and putting distortion, I get a new equilibrium, and the new equilibrium will be more desirable. Not just because I get more money, because I like what's going to happen in new equilibrium. So, and I think Oleg is pretty much in this tradition of saying it's a second best word. We're not in an optimal thing. Now, by putting some taxes on assets, I can actually get to a better equilibrium. And it's not necessarily more revenue for the government. So that's important. Okay, so now let's talk about this particular case. What's a financial repression trying to correct? And here I have 3 exchange rates. The blue is the ruble per dollar, the red is the euro per dollar, and the green is real. Why I took real? Because I want to take another emerging economies which is not subject to a war. And you know, whatever. This is just to show you that ruble basically over this past 5 years has had 3 times the volatility of the other currency. It's been very, very volatile. So now you think, okay, well, of course it's volatile. There's a war. Yes, but the question is it too volatile? Is this volatility of the euro because of the war affecting other people and damaging other people? And the financial repression by curbing down this demand for foreign currency might help reducing this volatility. And of course, there's nothing you can do about the shock. The shock is going to happen, but by reducing the volatility, I reduce the adverse consequences of the shock of the economy. And that's sort of the spirit. So basically, here's the point. Like, think about Russia or Ukraine, very likely to experience large fluctuation in exchange rate. This fluctuation by themselves, not because of the shock, just by themselves hurt the economy. Now, Oleg says, okay, let's do financial repression. And in particular, what I'm going to do, a very specific form of financial repression, I'm going to tax the household holdings of foreign currency. So I'm going to stop them. You know, I could even almost completely stop them holding foreign currency. And the questions there too. Does this policy, can they reduce the exchange rate fluctuations that arise following a shock? And if they do, is it a good thing? That's sort of the key question. Now, okay, I took them all. So being connected to the Minnesota, whenever I see sticky prices, I get a little bit upset. The one thing, not because I don't understand them very well. So one nice thing about this model, it can basically completely rid of the sticky price. It becomes a real model. So what really matters is the real exchange rate. And, you know, we can call it currency, but you really can call it domestic good and foreign good. So that's kind of their models stripped down to 3 things. So there's utility. So the Russian guys have non-tradable and tradable. And you can think about, those are endowment, fixed. So no volatility in of course, you know, the war is going to affect all of this, but for the key of the paper, you can think about why being endowment of non-tradable is fixed, because in non-tradable consumption is equal to that. And they have Y star, which is an endowment of tradable, think of oil, also fixed. Now, the utility is exactly as these guys. You have utilities for tradables and non-tradable, but you also have this utility from foreign bonds. Basically, you like this holding of dollar bonds, and basically a shock to FI goes up, utility goes up a lot. So you want to hold many more foreign bonds. Intratemporal optimization, you just, given the exchange rates, you equalize the ratio of tradable to non-tradable. Very standard. And theta is the elasticity, tells you, you know, if there's an exchange rate depreciation, I want to buy less of the foreign good because it's more expensive, and how much of it is determined by theta. And then there's the Euler equation. Now, Oleg writes in a way which is nice for some sense, but less intelligible. The simple, I write in a slightly different way, which is, I think, maybe easier to interpret. When you buy foreign currency, what's the cost of buying foreign currency? Lambda. Lambda is basically the shadow value of money in period T. Lambda times the exchange rate. And it's the cost, it depends on the RH. RH is the return of foreign currency. The higher the return of foreign currency, the lower the cost, because you're going to get a lot of money. So basically the government, by making RH low, can increase the cost of buying foreign currency. What's the benefit you get? Well, you got the beta lambda T, which is standard oil benefits. Tomorrow you got the foreign currency. You can use it for spending, but it's an extra benefit. This kappa, which is basically the derivative of the term up there. Basically, that you like these dollars, and this is how the further you are from the bliss point, the phi t, the more you want to buy foreign currency. So that's the other equation. Those are the 3 equations, and this go. Basically, what I did, I take this equation and put them in dinar. That's actually pretty simple. So now, this is the one. The final important equation is the country budget constraint, and that basically tells you that you have the endowment of foreign tradables. You consume some of these, and the rest is accumulation of your current account. So change your net foreign asset. So that's the thing. Now, why why do we want to use financial repression? Well, in this model, there's two possibilities, two reasons for using financial repression. The first one is that financial repression is a way you lower return on foreign currency. So the guys go buy, the private agents go out and buy the foreign currency, and they have a low return. But you as a government can access the foreign market. So if you don't do it, if you get this money, pay a low return, put it on the foreign market, you get return. So this is generate revenues from the government. That's not their focus. That's a kind of a side. It's true, and they have a section in which that might be desirable, but that's not the main focus. The main focus is that by putting financial repression, you reduce the demand for dollars, you reduce the dollar appreciation, and you might like that. So that's the thing. So what happens? Okay, I don't see the. Yeah. Okay. So this is a case in which you cannot do foreign exchange intervention. So in this case, the foreign guys want to buy dollars, and you do nothing in response to that. So you let the foreign guys buy dollars. Now you have a shock. You have a shock to FT. This is as Alberto was discussing. There is a war, and everybody wants to buy dollars. So the first panel on the top is the shock to FT. So how much people want $1 more, and model is pretty persistent. So there's an increase in the desire for dollar, and it stays up. Now what happened in response to this thing? B is the amount of dollar, it goes up. Now, does it go up fully to the bliss point? No, because why it's costly? Because to buy dollars, you have to reduce consumption. So the agent's going to do a little bit of that. They're gonna buy some more dollars because they like them a lot. But look at the bottom right panel. They're going to also reduce their consumption because it's it cannot do both. They have a budget constraint, and so those are kind of the reaction. And as a consequence, the exchange rate will appreciate because now the foreign goods are more expensive, so the exchange rate goes up. So that's what happened in response to the shock. Now, why is this a bad thing? Well, the bad thing is that because now these guys think about this, the country has constant output of tradables and non-tradable. So the efficient thing should have constant consumption. There is a side show of financial shock, but the financial shock should not be affected that. But because of this financial shock, you have a deviation from perfect sharing, so you have a drop in consumption. That's not a really good thing, but that's kind of like the whole mechanism of that. And the idea is, well, maybe if I do financial repression, these people are gonna buy less of these bonds. I'm gonna have a better situation. So that's just explanation. Now, so that's the idea. I have the same shock to the desire for foreign reserves. Now the government is going to say, okay, now I want to do a financial return. The moment I see the shock, I put a big tax on buying dollars, so people will buy less dollars. I'll have less on appreciation, and will be much happier. So would it work? Okay. Okay. Now we have the same shock to the desired reserves. But now, at the same time, as I showed before, the government's going to put financial repression. What's going to happen? Well, it's going to happen. A similar thing is going to happen, but because now it's more costly to accumulate reserves, I'm going to accumulate less reserves. And if I accumulate less reserves, I'm going to be able to allow higher consumption. So basically, say, and the exchange rate is going to appreciate less. It's going to be lower appreciation. I'm going to reduce the consumption less. Before I was cutting by 6%, now I only cut by 5%. But on the other hand, I increase the reserve gap. Now I really love these reserves, but because they're more costly, I buy less. And so I'm less happy because of that. So all these things say, yeah, I'm going to move in the right direction on one dimension because consumption of foreign goods drop less, but I'm moving in the worst direction in the other one because now I'm far away from a bliss point. So the answer, I had this question, can financial repression reduce the fluctuation exchange rate? Yes, it can. But is the reduction desirable? No, actually it's not. Actually, the agents are worse off. Yeah, there's a less consumption drop, but they're far away, so they are worse off. So why they were worse off? Well, in reality, if you think about, there is a representative agent here. So he thinks, when he sees his shock, says, well, should I increase the reserve or should I reduce the consumption? he fully internalized it. There's no externality. So when he knows that if you have to increase the reserves, what's going to cost a reduction in consumption. So the cost is already there. If you put an extra wedge, you're just going to make it worse off. So there's no externality. The reduction in exchange rate, as was discussed, is fully optimal. People don't like it, obviously, but it's efficient given the market structure. Okay, so that and market structure, I want to stress market structure here because basically you have only a bond. You cannot insure against the shock. The shock hits. The only thing you can do is now really like dollars. Of course, I want, but I also like consumption. I have to buy a little bit more dollars to cost me consumption. That's it. It's efficient. Now, why could it be a world in which this financial repression is actually desirable? Now, Oleg has a word, and Alberto mentioned, I think, the most natural thing to me, think about that there are some other agents in the economy which are, so there's guys who buy reserves, and they care about the exchange rate because if the exchange rate appreciates, foreign goods is more expensive. But there's also other agents which have a lot of dollar debt and they have local currency revenues. Now, those guys sitting there, they do not buy foreign reserves. All of a sudden, they face a big exchange rate appreciation while they suffer a lot. The constraint tightens and they are in trouble. But this effect is not internalized by the first guy. When I buy reserves, I know that when the exchange rate is more expensive, going to make costly for me to buy the goods, but I don't care about the other guy. I might care to learn an equilibrium, but I don't care directly. So in this case, there is an external effect of the exchange rate. The exchange rate depreciates too much relative to some Pareto optimum, and so the planner might say, or the government might want to put financial repression. So in this case, financial repression might be optimal. Note though that in the context, if you have foreign exchange intervention, they're still more desirable. I guess keep one slide maybe. Yeah, I think that's 2.5. The result, I'm just going to talk briefly in this one. The result that Oleg also show about this, financial repression is not very good because it just distorts. But one thing that's really good is foreign exchange intervention. So once there's a big desire of foreign reserves, you just give them to the public. And if you have them, you give them. But if you don't have them, you want to borrow from the rest of the world and you give it to the public. Now, I was a little bit puzzled why foreign exchange intervention is such a dominant thing in this world. And Oleg mentioned Friedman rule. I think another way of thinking about that actually is that if you have foreign exchange intervention, it's a way of completing the market. So you basically have this shock. All of a sudden say, oh, I really like reserves. The government says, here I'm going to give you the reserves exactly in the state where you like them. And so why in the other cases, you cannot complete the market, the only way you can insure against or prevent against the shock to reserve is by buying the bonds. The foreign exchange intervention are like completing markets. And so they are always more desirable. So even in this case, where you have this suppose you have these other two types of agents, and you say, well, I want to use financial repression. But if you have foreign exchange intervention, they're still dominant. So that's kind of an important point of the case. The other case is government revenue. So if you lower the rate of domestic currency below the international rate, and if you don't do foreign exchange intervention, so you basically take these bonds from the foreigners and invest abroad, then you generate revenue. Is it desirable? Well, it depends on how constrained you are. Suppose you're in a war, you are at the top of the Laffer curve on all your other dimensions. Are you using the extra revenues? You might use that for extra revenue. So that's another justification for financial repression. They talk a little bit about it in the paper. But okay, so I'm just going to conclude. So I've discussed few papers and read few papers by Oleg and Dima. They're not super easy to digest at first. And people say, oh, it's a joy to read. And at the beginning, it's a little bit hard. But they're very rewarding, actually. Once you digest, they're usually very deep and very insightful. For me, it was the case. I think it really clearly elucidates how when financial repression is useful and when it's not. And it wasn't obvious to me at the beginning. And in particular, given this context, it's going to be very important to think about this policy. If you have an economy who's in trouble and it's hit by very large shock and is worried about exchange rate fluctuation.
Thank you. Excellent discussion. I hope in all panels we have such prepared discussion. So we have about 25 minutes for comments. I would ask for a round of comments, questions, please. Ed Glaze is the fastest. Andre, okay. We'll start with Andre, then Ed, and then others can think. And then Oleg, you can also answer some of the points that were already made. Shebnem also raised hand.
Very short. So did you show us what happened in the data? Because as I understand, one of the purposes of financial repression was to make local households switch from dollars to rubles. Did they actually do that? Because you may think that given the volatility, they would prefer to hold even more dollars than before.
We'll collect and then we'll come back to you.
So I'm having trouble connecting this with Russia because I have so much difficulty thinking about what Russia's objective function is. And I'm pretty sure it's not maximizing the welfare of its citizens. And so it seems like financial repression can do lots of things if you're playing a complex game against your citizens. Of perhaps you want to make sure that they're not, going on vacations out to the West. Perhaps you want to make sure they're not buying fancy Levi jeans and feeling good about America because they're buying it. And I don't know I can't think about all those things, right? Because I don't understand fully what other policies could achieve the same thing. But I think it's useful to sort of think about as broad a definition of objective function for the Russian state, which is different than the question you started, which is like, when does a benevolent state want to use FR as opposed to other tools, which is a very valid question. It just doesn't feel to me like that's the question that Vlad Putin is asking himself.
Thank you, Shebnem.
Yes, I'm actually going to follow up on that at a point, and both Alberto and Fabrizio made this point too. So how do we really put Russia here, right? I mean, not only that, obviously, Putin is not thinking about maximizing the welfare of citizens. Also, if you completely ignore the revenue side of the story, right? Why they do it? I mean, because if you think about these emerging markets, right, countries like Turkey, Argentina, it's always about the revenue, right? I mean, it can still go to the exchange rate. It doesn't have to be to the interest, as Fabrizio put it. Anything that distorts the decision, but revenue has to be a central dimension. And then, if that is the case, if Russia also told this revenue angle, and then since we are now thinking through the currency market, it has to be that I want to keep the dollars in my hand. I don't want to give the dollars to anyone. So I want to somehow have a way of collecting all the dollars. And is going to be meaningful if there's full segmentation, that perfect inelastic thing, which then, how is that going to happen? Then you have the export revenue coming, right? So I feel like a country like Turkey is also a very good example, right? So they did it. They want the dollars in their hand. They cannot at all. There are no capital controls, no war, no sanctions. There is no way of limiting the dollars in and out of the country, because they also cannot do it because Turkey is a EU accession country. But they did this very, very kind of backdoor way of let me get this because that's a source of government revenue, and also prevent dollarization, prevent people saving in dollars, right? So somehow that has to be part of the discussion, I think.
Oleg, first.
Yeah, thanks so much. So I want to say, first of all, we had the idea of this paper for a while, but this paper didn't exist in the form that you read 5 days ago. So thanks so much for the discussion, for reading it on such a short notice. And actually, I was not quite sure whether it makes sense or not, given how fast it was written. So, but it seems like, we communicate. We can communicate better. I totally take it from Alberto's comments. We will adopt Fabrizio's definition of financial repression, which I think is useful and actually gets at the heart of a lot of questions. So typically, we think of financial repression used when it's the fiscal capacity issue or fiscal deficit issue for absolute majority of countries. And that's why it's the focus. But one country where we talk a lot about financial repression is China, and fiscal revenues is not the goal there. And what's really interesting about Russia, and it didn't quite come out from my presentation, I didn't have quite enough time to step on it, at different points between 2022 and 24, which is our sample, fiscal concerns sometimes were a problem and a consideration, and sometimes they were not, right? So summer of 22 is a problem that ruble is too strong. There are too many euros and dollars coming from exports, that ruble is too strong, and it puts pressure on the government, on the budget, right? And they want to actually relax financial repression to depreciate the currency. And this is the first period when actually it's the fiscal concerns. If we go before, and that goes to Ed's question, what was the considerations in from the beginning of war in February and in March, the key consideration was stabilize the economy. And this goes to Andrei's comment. Like, how can we judge whether they achieved the goal or not? Well, depreciation stopped, right? It was a massive depreciation wave that was coming, a bank run, and they managed to stop both. So now, I'm not sure we deliver on the question, was there something that the Western governments could do to actually like enforce the crisis equilibrium as a unique equilibrium, no matter what Russian government is doing? But given the sanctions that were observed, Russian government had the tools to stabilize the economy, right? That's like a fact, right? They imposed enough financial repression to curb the depreciation. We don't have the data on exactly like composition of dollar versus euro versus ruble accounts, but the fact that they managed to curb the depreciation meant that they slowed down this demand, right? Like selling ruble deposits and converting them to foreign currency deposits. One more thing I'm gonna say here. Yeah, so I think this is like really the big question is really this. When the objective of the government is to stabilize at all costs, is financial repression a powerful enough tool? We wrote a model where it kind of is, because you can fully eliminate that equation of demand for currency. I think in the real world, there are limits to that. We don't have quite the tools to do it, right? And the limits have to do with probably externalities, right? What the externalities you impose, right? There is an externality from a ruble depreciation. If this is the priority, this tool is pretty powerful, but you probably impose other externalities when you do a lot of financial. For example, if you say you cannot withdraw from your account, well, it will stop payments in the rest of the economy, right? And so the question in March 2022 would be whether if you stop the bank run because nobody can withdraw from accounts, but will it lead to a wave of defaults? It didn't happen, but how close was the economy to a wave of defaults because people could not withdraw from the accounts? And this is a different type of externality associated with this, which is not part of it. It tells me I'm speaking too long. Last thing I was going to say is, one way of thinking about sanctions is exactly the split. There are sanctions that affect the budget constraint, and those are clearly most potent, right? There are sanctions that affect how much goods you can buy. This is the import demand sanctions, right? And so those clearly happen. The government has to take them as given. Financial repression doesn't help you undo them. Those are the two equations you have to respect. You can undo the third equation. And so I really like how you said, well, in the data, we see that the third equation must have played a big role, that the earlier equation, the financial decisions must have been playing a big role in the beginning. Well, the model wants that to explain a lot of the...
Financial repression or others will protect you against sanctions? It's like one question, and in some sense, that's production possibilities from your question. With the question, like, what is optimal for a guy like you?
Right.
For FR, right? And just conceptually differentiate.
Yes, so I agree. So we wrote a normative paper on the question of optimal use of financial repression. The truly really interesting question is, can you prevent a bank run, right, when it's happening, right? And this is where we're short of providing an explanation. Last thing I'm going to mention is the way we think about sanctions is not so much inflicting this financial shock, but segmenting the economy, segmenting it from the world currency market. So what sanctions probably do quite effectively is provide the segmentation. Segmentation gives the government a policy tool. Without that segmentation, so countries in normal times probably have much less segmentation. So this tool is more, this is one of the results that we wanted to emphasize, that sanctions that segment countries from the world currency markets give the government a potentially powerful tool.
We have time for another round. Yes, and also Dima, if you want to comment or answer, please do. There and then Dima.
So when I think about this problem of sanctions and all of this, the thing that I read in the paper is we want to do this to put pressure on Putin. And that notion of pressure, I think, is ill-defined. And I think that one could define it precisely here, which is you want to drive up, like what Putin wants to do is take $1 out of the economy to use for his own purposes. So I think a way to formalize the split that Ed just described is, does financial repression drive down the social cost of funds in an environment where you're subject to sanctions? Then you could, that'd be a tool that you could use to accomplish what Ed asked for.
Yeah, I'll let Oleg to answer that question, but let me just add a couple of things. So one is that, I don't know, I think there are political constraints, right? Going back to the objective of the government, I think there are political constraints. And so Oleg mentioned that it's interesting that once the ruble got close to 100, to the exchange rate got close to 100 rubles per dollar, right? And then people start spending much more attention to this thing, right? This kind of a psychological threshold. Government clearly intervenes. So I think it shows that the government does worry about. Maybe it's not welfare, but it's about how upset public is about these things. And another thing is that, again, maybe it's the third time I'm repeating the same thing, but I think there's a big also question about optimal response for other countries, right? About optimal sanctions. In many ways, it seems like these restrictions on the capital outflows from Russia were counterproductive, right? And there might be some other reasons to impose them. So people often mention that it limited Russian political influence in other countries, right? That this money couldn't be spent on these things. But clearly, if the objective is to generate this capital outflow, that was pretty bad policy.
Oleg, maybe back to you, and it's dividing into two questions. There was
I will add to that because this goes back to, again, maybe then this should be framed only financial repression when there is sanctions, because in countries without sanctions it cannot stop the depreciation. That's again the Turkey example, right? And then this goes back exactly this type of thinking. Well, okay, then what is the reason for depreciation? Is depreciation costly? And how do I think on then the domestic restriction, capital outflows, or controls on domestic? So I think it's very peculiar to think about financial repression when there's sanctions, and as a way of undoing that.
So this is exactly why it's in the title. That's exactly how we think about them. That sanctions either segment the economy or limit the supply of currency or limit the ability of household to access the world capital markets, and that's what gives the power to financial repression. I think even in normal times, currency markets are not perfectly integrated, and so there is some room to use it, but elasticities are of supply much bigger. And so going back to what Fabrizio says, why the Friedman rule here? Well, in the world, the marginal cost of a dollar is our star. From a perspective of a small country, the supply of dollars in the world is really unlimited, right? So what makes financial repression work is that somewhere in the system, there is an elastic supply of those dollars, right? So if you believe that Turkish households can really go around capital controls, or if they're not present and so on, and get those dollars at our star, financial repression would be completely futile. But same thing with financial repression. Like if the domestic agents do not want to save in the domestic economy, the financial repression of domestic savings will not achieve anything, right? And so it all requires a captive audience, right? And sanctions make the captive audience bigger. So that's what we want to emphasize, yeah.
Okay, we're actually ahead of time, but Yuri wants to put me exactly on time, so please, Yuri.
Thank you. Maybe this question is a little different from the main theme of the paper, but I think it is somewhat related to our discussion we had earlier today. So you have Russia, you have sanctions imposed by the US government, by European governments. As far as I know, there was no sanction imposed by the Chinese government. And so in principle, it's a moment for the Chinese currency to shine, right? So all Russians should be switching from the dollar to the yuan, or from the euro to yuan, or maybe some other currency which is not imposing any sanctions on Russian banks or financial institutions more generally. I was wondering if you see any movements in portfolios that various financial institutions held, or maybe households had in Russia. I'm going to make a forecast that, despite the fact that US and Europe being declared mortal enemies for Russia, most people continue to hold their savings in dollars and euros and not in Chinese currency or Brazilian reals or whatever other currency that they can have access to.
So I'll pass it to Dima if he knows more about this data, but there is a lot of anecdotal accounts of things that are happening. So what Linda brought up in the previous discussion is that the payment systems, and clearly there is shifts in payment systems, at least for bilateral trade flows. There is a clear ranking that yuan, it seems from anecdotal accounts that yuan prefers to rupees, but dollars are still preferred to yuans. Right. And so exactly for the ease of what you can do with that, right? How to write a model of that, I think that's exactly the most interesting thing of how to think why, we typically think about a currency when you can bring it from period T to period T plus one. But why in period T you would have a preference between yuan, ruble, dollar, and rupee? If somewhere in the world exists an exchange, why in static terms you think that one is preferable to the other? I don't think we have a model, but clearly there is something happening at those margins. And yes, yuan's been definitely gaining market shares exactly in transactions that were sort of under sanctions or in the shade of sanctions. Dima, you probably.
I know. I think it's also true within the economy, right? That the share of dollar deposits and euro deposits actually went down quite a lot. I'm not sure about yuan deposits, whether they went up. But first of all, I think it didn't even exist, I think, before. Now it does exist, right? And another thing is that many companies now, they issue debt, right? Bonds that you can kind of even buy on the market, which is denominated in the renminbi.
Okay, on that last final words, thank you the discussants, thank you the presentation, especially since we learned that this conference is the reason for having this paper, which is appreciated very much. So we have half an hour of coffee and drinks. We've been doing very well with speed. So thank you everybody, and thank you the presenters.
Okay, everyone, please take your seats. We are going to continue with the next paper.
You're also doing the.
Yeah.
Are you doing the?
I can or you can, what do you want?
No, I'm asking you. I see Simeon's.
I'm just going to sit here because they
Okay.
can see me here.
Okay.
Tito, who is presenting? Okay, so do you see this? I'm going to show you your time from here. You guys can see. You guys want to sit there? This is very good. People are still talking.
Yes.
Okay. That's good. Okay. All right. Next paper, we have Tito talking about the wartime labor market, the case of Ukraine. Please.
Well, thank you so much for having us. This is a joint paper with Giacomo Anastasia, who is sitting there, a young economist with a very broad research interest, which is not something that happens frequently, and Alexandra Zolud, who I will never end being grateful to, because he has been really so important in our work and has been working under very difficult circumstances. We had several calls that were interrupted because of blackouts and the difficulties of various types, and he has been always so important in doing this research. And I'm grateful for all of you who asked us to work on this, because it was very enriching for us, and we learned a lot by studying a wartime labor market. So let's see if this works. It doesn't seem to do so, so we need to go. Okay. So the big question that we ask ourselves and in this paper is how does a labor market operate under a prolonged conflict? And to what extent does it differ from a peacetime labor market? And clearly we take the case of Ukraine, and it is quite unique because it is certainly a prolonged war. We are almost 4 years down the road of it. It is a war that, as we will document, has been involving the whole territory of Ukraine. And at the same time is a country that have been keeping some sort of statistical measurement of the labor market. Unlike previous wars, where we were lacking information about the evolution of the labor market and many other important magnitudes, here we could rely on statistics. And by doing that, we could really see what was going on in the labor market. I think that also our finding, given that the type of shocks that we are going to document are to some extent related to the supply side, some of our findings could also be relevant for to understand better labor supply shocks. And this is a problem that many countries, given the demographic transition, are going to face in the years to come. This, I would start with this picture because there is the idea that the war in the Ukraine has been like the First World War. So basically the war at the front line and nothing happening inside lands. As this diagram shows, actually this is mapping episodes, events of conflict, bombing and destructions being done. This has been affecting the entire territory of Ukraine. Clearly there is a concentration along the front line, but everywhere, you know, the entire country was exposed to the conflict, clearly to a different degree, but the entire country was exposed to it. So clearly, you know, the labor market is something that is deeply affected by that, because clearly there are the type of friction that you have during wartime are completely different than those you experience in normal times. People being scared about losing their life in the commute into work, clearly informational problems, blackouts, and all the type of things that you could possibly imagine. Let's see if still doesn't work. Okay, so I'm sorry. Perhaps I should move there and use the mic there. Why not? No, that one. Okay, so perhaps you can hear me even if I don't use a mic, but anyhow, no, perhaps for those connected is important. So there is some literature looking at the effect of conflicts. This is mainly macro. The micro literature is mainly focused on post-war periods. So what we have been doing here is to really look at what has been going on during the war. And our contribution is clearly, you know, when you have to study under a fog of war, is, you know, there are a lot of challenges that you have to face. Clearly, there are borders that are changing over time. There are clearly events, big shocks that take place at all the time. So I think our task has been mainly one of providing as much as possible an in-depth description of what was going on. And basically, our contribution is fivefold. First of all, we want to quantify the shocks. So this is an accounting exercise, and also the reallocation that has been taking place and the changes in the nature of the reallocation taking place during the war. Secondly, we want to assess the effects of the war and the exposure to a war on matching efficiency. Thirdly, given, you know, in light of also these shocks that have been taking place, thirdly, we want to document the heterogeneity in this matching efficiency, as well as in what has been going on to aggregates, labor market aggregates by region, sectors, and over time. Fourthly, we want to see what has been making possible, because that will be one of our key findings, that the efficiency of a matching function has not been deteriorating as one would have expected during a war. And so look more specifically at adjustment channels mechanism followed by in the recruitment of firms, how they've been facing this type of shocks and the way they reacted to it. And finally, we will draw, as requested, some implications for policy. There are three clarifications that are important to be made at the outset. First, we only cover civilian employment. So conscript people being mobilized and going to the military will be considered as a reduction in the labor supply. Second, we will cover only the formal sector. We are aware that in the Ukraine, there is a sizable informal sector, but unfortunately, it's very difficult to get any information, especially during the war, about the informal sector. And one can make different type of guesses about what has been going on to the informal sector during the war. And it's not clear what would be the prevailing direction of these changes. Thirdly, we focus on the government-controlled territory by Ukraine, so we don't cover Crimea. And for the matching analysis, we are also not going to cover the partly occupied region of Donetsk, Luhansk, Kherson, and Zaporizhzhia. So let me tell you something about the data we have been working on, thanks really to the contribution of Alexander, who was very important in this. Ukraine had a modern labor force survey, but it was discontinued during the war. Still, after that, a quarterly household survey has been carried out that provides some coverage of actually the labor market, clearly not as accurate as a labor force survey. And this survey has been carried out by this agency and has been used by the National Bank of Ukraine since then, and thus provide quarterly data on labor market developments. We could also have access to administrative data from the State Statistical Service and the National Bank. We also were able to get access to high-frequency data from the largest online platform for the matching of job seekers and vacancies. And this reports on a weekly basis stocks of inflows and inflows of vacancies and resumes, so applicants for job seekers. And also we have information about the posted wages in the vacancy and the asked wages by those applicants for this. And so to tell you about, this covers some 125,000 firms and about 4.5 million workers, which is about 1/3 of formal private dependent employment in the Ukraine. So we believe it's quite a high coverage. And finally, we were able also to get access to this survey that was done in cooperation with the Swiss Public Employment Service, looking at recruitment policies of firms. And this survey was done quite recently in January of 2025. Unfortunately, it's a one-time survey, so we don't have time series there. So let me start with the first part of our contribution, for quantification of an accounting exercise to really measure the type of shocks that Ukraine has been experiencing and making some comparison with developments in other countries. This is an attempt to quantify the labor supply shock. So we look clearly at the refugee. The refugee, they left the country just at the beginning of the war. There were about 6,600,000 people leaving the country. Clearly, only a part of them, many of them are children. Other are women in working age, but you have to take into account that the labor force participation of women was not that large at the outset. So when we have to calculate the effect on the labor supply, that clearly is way lower than the number of the refugees. So we are in the order of 3 million in the high scenario. Here, clearly the increase in the military and defense, also that led to a reduction in the civilian labor supply, but was quite consistent, although there as well, the labor force participation was not 100%. So clearly the numbers are lower than those mobilized by the army. Then we had, unfortunately, the casualties, the people being injured. And in the high labor supply shock scenario, we also include an effect on labor force participation, but don't misunderstand. It's simply an attempt to measure those people who have been forced to become inactive because they had to take care of one dead person, the school were closed, all of these type of things. So overall, the total loss in the controlled territory, it was of about depending on the scenario, but was more than let's say the baseline is about 3,400,000 people. So almost a 22% reduction in labor supply. This is a very large, and I will give you some example of other countries, a very large labor supply shock. We also try to quantify the labor demand shock. And here, what we did was to get some estimates of overmanding by simply assuming that productivity has been remained the same as before the war, and looking at clearly the number of workers that would be needed to achieve the same level of turnover that before the war, and compare this to the initial year. So these are the estimates that are produced in the right-hand side. So I talk about 17% of private dependent employment in overmanding. So in principle, these are clearly not employment because clearly not overmanding is there. So, but the excess labor in firms. The second measure is based on survey, an enterprise survey that tell us to which extent the firms are operating at full capacity or below capacity, and from there as well we can get some measure of this overmanding that are quite consistent with those that we get from the other estimate. And finally, from the online job platform data, we could also get some data on the hiring freeze. So we can look at the drop in the stock of online vacancies that had been taking place at the beginning of the war. And this is basically the numbers that we get. So it's a large labor demand shock, but is smaller in magnitude than the labor supply shock. And also, if you look at the labor demand over time, as we do in this diagram, that use the platform data to look at the enterprise survey data, sorry, to look at how firms were operating with respect to their capacity, you see that the blue part that are firms that are operating near full capacity is expanding over time. So the labor demand shock was large, but was not as persistent as the labor supply shock. The labor supply shock is there. I mean, people didn't come back. The return migration from the refugee was very small. So we still are operating in a country that has lost millions of workers or potential workers at the outset of a transition, and these people have not come back. So to give you some comparison to understand the magnitude we are talking about, we can possibly find examples of similar labor supply shock in the Serbia-Montenegro case during the First World War, where basically the labor force declined by some 30%. There was this internal displacement in the USSR, also from the Ukraine, by the way, under the Nazi invasion, and then the Rwanda genocide. But there are not many examples of such a sizable labor supply shock taking place immediately at the outset of the war, to a large extent. The labor demand shock is large, but can be compared to what has been going on during the great financial recession in the US. So, for instance, in the US, there was a decline in registered vacancies by 25% at the outset. Online vacancies that are more volatile than registered vacancies dropped by 1/3. And also in the UK, something similar took place. So the labor demand shock was large, but somewhat more comparable to things that we had seen, not in a long time ago. So clearly one would have expected that these very large shocks could have had a major effect on the aggregate labor market. And plus, there were clearly also this wartime friction I was mentioning before. However, if you look at the aggregate figures, you don't see such big changes. The number of people officially employed dropped by 16%. That's a labor supply effect, but then was relatively stable. The unemployment rate went up from 9% to 13%, but then, and it is going down to about 11, some last figures also around 10%. Real wages dropped. The drop initially, but then by 2024, we were back to the pre-war levels. And clearly, there has been a large dispersion of employment growth across sector and region. So, this aggregate picture should not conceal this heterogeneity. So this is to give you a longer time perspective. So we start here to 2016, and the left-hand side diagram is the unemployment rate. So basically, you see that we are almost going back to the pre-war conditions. The right-hand side is wages. The continuous line is real wages, and the dotted one is the nominal wage. Both dropped, also the nominal wage slightly at the outset of the war, and then it recovered. You know, Ukraine was in a period of high inflation in some years were about up to 27%. So that explains the divergence between the two lines. We also try to characterize the reallocation that has been taking place under these circumstances. And in order to better do so, we clearly want to see to which extent the reallocation was related to the exposure to the war. So we have been collecting this data on air raid alarm data. This is an online repository that basically map and counts alerts from official sources. So these are sirens sound when there is a missile or drone attack. And they remain active for the entire duration of the event. We developed three measure of exposure. One is the total duration of alarm measured in hours. The second is the number of alarms events per 10,000 residents. And the third one is the number of days with at least one active alarm. Now, clarification also in this case, the case of a contested region is very difficult to measure this because clearly these are partly occupied by the Russians. So we simply encode as being highly exposed to the war rather than having this continuous measure. This is the map that we can build up by dividing oblasts, so regions of Ukraine into tiles, depending on their exposure to the war. You know, the red, the contested region, as I said, is encoded, while the others are, as you can see, also Kiev is part of the high exposed part. This is simply to look at employment by exposure. You see that clearly the dynamics of employment is quite related to the exposure to the war. The regions with low exposure got a relatively small reduction of employment, while clearly the reduction in employment were very large in the contested areas. The right-hand side is instead the measure of self-employment. Are individual entrepreneurs, because self-employment is also important. And this is something that related to the contested regions. Instead, here we had really the view is something that I found interesting, because when you do a simulation with the Mortensen and Pissarides model, and you look at what happens under which condition a labor market would not operate, then you produce diagrams of this type. But this is real data. So these are real data from the contested regions where vacancy rate goes to zero. Basically, a labor market in this condition is no longer there. And here are regions where still a part of a territory, sometimes also the most populated areas, are under the Ukraine control, and still a labor market is not operating. So sectoral reallocation, what has been going on in this respect? We did compute a synthetic index of a pace of structural change. And what we find is that there was a major acceleration of structural change. So more reallocation of workers and jobs across industries as the war began. Also, there was a change in the nature of the reallocation. The names here are small, and I don't want to go in the detail. But the key issue is that it completely changed the direction of if you do a correlation of growth rates before across three-digit sectors before and after the war, you see the correlation is close to zero. So clearly, it completely changed the direction of a structural change. And as you can see, while before the war, basically there was some increase in retail trade and also some activity that were related to information services and building completion and finishing, all of this type of activities. After the war, instead, we had the major development of military and military-related sectors, as one could imagine. So the red bars there are sectors that are related to the military. There was clearly accompanied to this, an increase in the budget devoted. This is some measure that we could possibly get by looking at the composition of a budget or a public budget. So more spending in military wage bill after the war, as that is rather intuitive. And here is also an attempt to measure the public versus private reallocation. The red line is the, is basically is a measure of a total wage bill in the public sector. So these are social security contribution collected among public sector workers. The change in the level of employment in the public sector has been relatively mild. So here, clearly, you have a measure of so the cost, the social security give a measure of the reallocation that has been taking place between the private and the public sector. By the way, this is a completely different type of reallocation that the one these countries have been experiencing during the transition to a market economy, where the shift was from the public sector to the private sector. Here we have seen just the opposite taking place. So to recap all of this evidence that we produced so far, huge labor supply shock and larger labor demand shock, but less persistent than the labor supply shock. Major reallocation across regions, sectors, and between the public and private divide. Moderate aggregate impact, visible aggregate impact on the labor market. So clearly the big issue is how efficient has been the Ukrainian labor market in absorbing all of these shocks, and to which extent this is related to the exposure to the war. So these are the online platform data, and on vacancy filling and market tightness. So this is telling you that if you look at the aggregate numbers of vacancy filling, they have not. There was clearly a big drop at the beginning of the war, but then they resumed to the previous levels. And the right-hand side is a measure of market tightness, also market tightness in the regions that were not too much exposed to the war, resumed to the pre-war levels to a large extent. So to analyze the efficiency of a matching process, we estimated a Blanchard diamond type aggregate matching function. We had to recover the matches by using a stock flow identity, but this is something appropriate because the way vacancies are registered there is something that is costly for firms. At the same time, the cost is only on the inflow side, and there is no cleaning in terms of, so if vacancies are unfilled, they remain in the register. The only way a vacancy can be taken away from the register is when they correspond to a job finding. So the vacancy has been filled. So I don't want to enter the details. So we look at the first specification of our matching function allows simply for this term, the post-war dummy. And here we are interested in the sign of this coefficient gamma that discriminate between the pre-war and the post-war conditions. So our estimates suggest that the reduction in match efficiency, so this is is like disembodied technological change, if you like, it's like a production function. Disembodied technological was a reduction of about 15%, according to various estimates, and also we did the same. We look at the heterogeneity of this effect, allowing for this coefficient to vary across oblats, and as you can see, there is quite a large heterogeneity. The regions that experience the largest drop in efficiency are those were more exposed to the war, as one would have expected. There was also quite significant heterogeneity by sector. We also use the continuous measure of exposure that I presented before, and again we get this negative effect on exposure. To tell you something about the size of this effect, we look at the similar estimate being done in the US during the great financial crisis, and looking at the estimates of impact on matching efficiency, done in exactly the same type of specification with this disembodied term. And in that case, the drop in efficiency was as large as 25 to 30%. So the decline in matching efficiency taking place in the Ukraine seemed to be been relatively modest, according to our estimate. But by the way, they also are consistent with the constant return to scale specification. So clearly there are some caveats to this analysis. The first one is that we may not capture the full universe of a labor market. We capture the digital market, but the digital market is fairly developed. So about 90% of the Ukrainian territory is with internet coverage, and a large fraction of workers are online. Clearly, there are also clearly considerations about measurement error. So the last part of our paper is instead related to how this was possible. So how this large shock could have been somewhat absorbed by firms facing shortages of some workers and big reallocation taking place. And the answer that we could possibly get by looking at this survey of firms was that there was some mobilization of underrepresented groups, women, elderly, and disabled people. So an increase in women being employed in positions that were traditionally held by men, like in mining. The fact that Ukraine was able to mobilize people aged 60 and more, employees with disability and special needs and their involvement, and the use of remote working. This is something clearly that was very important in absorbing this type. And finally, wage flexibility. So let me just give you very quickly some evidence along these lines. This is based on the survey I was mentioning at the beginning. So the units here are firms, and they tell us about their plans. So as you can see, in the region that are more exposed to the war, there is more hiring of internally displaced people. There is also more hiring of people aged 60 and more. On the hiring of the people with disability, the situation is a bit mixed, and also because there are clearly some physical difficulties in hiring people with disabilities in regions that are very much exposed to the war. And finally, we get a larger use of remote working in this area. So remote working has been very important in allowing the labor market to keep on operating in this area. So wait 1 minute and I'm done. Here instead we look at the gap between the asked wage by the applicants and the posted wages, and we see that both have been dropping it immediately after the war, but then there was a convergence of the two. This is also looking at the same thing by exposure, and you see that here there is not much of the compensating differential that one would think, so a premium for the risk. And finally, we look at this by decomposing the different categories that are for which vacancies are classified. And here there is something which is relevant also from a policy standpoint. So the fact that the gap between asked and posted wages is very large and is positive in the case of technical knowledge and other occupation. That is something important also to think about pressure for out-migration from. So to conclude, this full-scale invasion generated one of the largest combined labor supply and reallocation shocks in recent history. Despite these shocks, the labor market has proved resilient. Adjustment occurred profound regional and sectoral reallocation. There was uneven impact, and clearly based on the exposure to the war. There are clearly major structural challenges ahead, and here these are the list of a priority that we think are important. If it is true that long wars are won in factories rather than in battlefields, it's very important to support this resilience of the labor market and improve it even more. And these are some of the suggestions that we develop in the paper, but I'm out of time, so I'd like to stop here.
Great, thank you. first discussant, Alessandra? Elena? Okay, yeah, Elena. Elena, yeah.
Okay, so while no, doesn't work? Works. So while we're getting set up here, I will talk about why this paper is wonderful, then do some petty nitpicking at the paper and future work, and then I'll repeat again why the paper is wonderful. And let us start here. Why is this paper is wonderful is because we have people in the government, like the deputy governor sitting here, who is forced to make big policy decisions in the middle of fog of war and high uncertainty. And what is he to do? He goes maybe to the old CEPR compendium, which was wonderful, on the war economics from the Second World War maybe, or from other conflict cases. But we don't have so many examples of the war economics in the middle of the outright total war situation. Now, I'm not going to go over the references much, but hold on, where did I go? Oh, how did I go back? I go back here. Sorry about this. I just jumped. So yeah, we have as you presented in the literature overview, we do have some who wins wars in terms of recent, publications. Size matters, resources matters. Okay, that's only so far helpful, right? Wars are costly. Okay, that's also great information. But how does it change my policy decisions today, right? Whether in Ukraine or in Poland, in Latvia, or in Germany even, right? And then we also have exactly this older compendiums on the completely different types of economics. Or we have all the research which talks about, say, Adam Tooze on Second World War. It's a big compendium, it's very historical, and it doesn't talk about the central bank. So I mean, in a way that we would like him to talk about it, right? Because he's a historian. So I think that's why it's, oops, I didn't mean to say it in a bad way, I meant in a good way. But with all respect, and but so basically I'm not going to go too much over what the paper is about. It's very clear. Authors here are very coy. They say it's descriptive. No, they've done a lot of econometrics, which my co-discussant will talk more about, and it has also clear implications. Now I'll start picking a little bit, but very much selfishly, because I had to write something smart here, right? So my first question is a bit more on the data, because we're trying to do something very, very early on and very similar on Russian data, and there are some similarities, and it's a hell of a job to do this unpicking of the postings, how frequently something gets posted, how do you clean out the fact that sometimes one company comes in and dumps the data in one day, and how do you clean it out? Or maybe that the median wage gets stuck somewhere because people tend to repeat the same big numbers, right? So basically any help you can give us, other researchers, it will be fantastic, maybe as a data appendix. Then on the sort of a similar kind of data related things, exactly the job posting mechanics, then decision to break in industry into military and non-military, because again, I'm looking at Russia. For me, it's very hard to bring it out because they were, of course, very secretive. If we talk about the metals production or vehicle production, of course, I know that it's military, but it's not that it's going to come out and tell you about it. And I think Julian Cooper, when he looks at the Russian fiscal spending, he also has, Buffett does some work on it and others. So that will just help for us. And if you look at the shock to the labor force, I had a couple of small comments. One is in terms of people who tend to stay behind. You have a constant assumption relative to the share in the labor force. Given the conversations I had with many of my friends in Ukraine, grandmas stay behind. Oftentimes they're elderly parents who stay behind, not necessarily people who are so active in the labor force, but maybe it's a worthy adjustment. And another comment is about men hiding from mobilization, or now younger men being allowed to leave, how that is affecting your labor market calculations. One very quick one on alarms. I remember distinctly the central bank annual conference. Nobody reacted to the alarm. Ukrainians have a way of reacting to it. So only foreigners had it on voice. Everybody else had it quiet, and so only the foreigners at the panel sort of looked at it. But yes, alarms matter, and you do a lot of testing there. But maybe going back to this first paper that you have, not paper, the figure that you have on Wiener, maybe on actual threats. Maybe people in Kiev feel a bit more protected and they're not reacting as much on the alarms until a moment, or maybe looking at the number of the missiles coming. So I don't know, maybe there is basically sort of people are getting fatigued by alarms. And I really don't know how many people go to the shelters really ever, because and here also you make a very good comment that Russia maybe doesn't target sort of regions that are productive because they have the military strategic objectives, but in a way targeting military productive regions should be part, unfortunately, of their objective. And if you look at the way that they do sort of more hits at night, partially probably to avoid being detected, but partially also to have people stressed at night, and also produces the perverse effect that nobody goes down, because you cannot sleep like this. You spend a couple of days like that and then you're done, right? And people have to continue to function somehow. So this is the little nitpicking. I will now go to talking again why the paper is wonderful and the background, just also because we are discussing here Ukraine. We discussed a little bit Russia's growth. Let's not forget that after collapsing 30%, Ukraine actually is growing 2-3% in recent years, despite attacks on the infrastructure and military, and the energy and other issues. This year probably is going to be around 2%. As Yuri was pointing out, there is huge budget deficit of 20%. Which will continue probably to stay in the near future. And that brings me to the central bank, which has this very difficult job of waiting for external financing, hoping not to go back to monetary financing, and successfully bringing down inflation, holding the policy rates until they bring down inflation. But at the same time, they have the issue of the labor market. So as you see that unemployment has gone down significantly. But at the same time, I'm speaking too fast. I'll be out of my points soon. So I'll slow down a little bit. So I really wanted you to know everything there is to know from my little knowledge. Unemployment is coming down sharply, but you see that the sort of more than 60% of businesses are commenting that they're having difficulties employing. And what does it mean? It means that your wages are going up, and we'll go back to the already difficult macro-financial stability situation and the role of the central bank. If you look at the next one and you talk a little bit about it, in terms of the veterans and their families, so you are very likely to have millions of people who will need to be integrated into the labor market. And if you look at the veterans receiving pensions, and also people with disabilities, that will also have a big drain on the public resources going forward, where the ratio of people employed versus everybody else who needs support will change dramatically, and will continue. It will be persistent shock to the public finances. And that tells you just how important it is to integrate these people into the labor force. And that's why this research is so important. We have also the issue that I commented on a little bit earlier is the share of the unemployment female and male. And we have seen actually a reduction in terms of the male unemployment versus a pickup in female unemployment. And it could be related to the fact that people are afraid of going outside. And, there is the issue, maybe the fact that younger people now can leave, maybe it will change it positively or maybe not. So this is something that we might want to look at. And of course, the gender issues will remain extremely sort of important in the near term. And then finally, in terms of people with disabilities, again, it's probably more than 3 million people. That's another very big shock to the market. But let's not forget that more than, I think, it's actually more than 50% for sure, do not, actually, yes, okay, while 40% do not need, okay, fine, 40, I think it's more than that. Many people actually don't need special adaptation in the workplace. So, and yet they're still struggling to find employment. And if you look at what the data set that you're using is sort of that open to recruit people with disabilities, only very few across different, industries, people are saying that they're willing to do that. So it's a big issue, but at the same time, maybe it could be easier solved than what we're imagining. And I will go very quickly to the various policy things that, we see. Good. So I'll go very quickly on the basically sort of the policy recommendations and future work, more so than even for you just sort of picking at your paper. No, it's more about future work. So basically, we have a structural shortage So what can be done? We're coming back to the policymaker today who's making specific decisions, right? We are also in the university. We would like to know what kind of professions will be needed, where the areas are, what are the skills that are missing. And also there is a flip side, of course, of Russia's bombing is that some universities, particularly in the eastern part of Ukraine, can no longer function the way they used to function, right? So in the literature that you mentioned, in terms of the hit on the the mental health, but also the educational outcome, so that kind of mismatch of the labor market could be worsened because maybe we're not producing enough engineers or we're not producing enough people of the specialized technical skills. And even if you do, as you point out in your papers, maybe they want to leave the country, and then we have a bigger issue, right? And then the endless discussion about return migration scenarios, whatever you can say about that. We've had experience where many Ukrainian workers went to Poland, went to Czech Republic, and actually we end up writing endless papers about why inflation is not going up in these countries, and probably because maybe of millions of Ukrainian employees that integrated very well, knew the language, and worked there. Did they come back? How, can we draw any sort of examples from their experience? Some of them probably were forced to come back during COVID, and ended up in the country because of the war. So some of these issues to look into. And then policies targeted at the vulnerable groups will definitely need to go much more in depth because we need to look for creative solutions. It is not educating. It's not educating women or disabled people only because it sort of puts them in a awkward position that something wrong with them. And it's also educating the broader society that that's okay. I think there will be also resistance from men, especially some of them, not putting these groups in conflict with each other, because when men come from the military and they will be wanting their mining jobs back, and then there will be women doing their job, what are we going to do with that, right? So we need to think forward on that. And then final one, hopefully for the next paper too, is the interaction between civilian and defense sectors. We talked a little bit about the productivity spillovers, right? And also the specific drain on specific industries that the military conscription draws. You touch a little bit in the paper, especially certain regions, and you say maybe it could inform policy about conscription, of course, with the trust in the government, but basically maybe sort of agricultural, some of the agricultural sort of professions, some of the, vehicle sort of repair. There are natural professions that are close enough to the military, and that's where you risk of making the labor market even tighter if you draw from them because they're like sort of the comparable skills. And at the same time, backwards, we know that in some brigades, people are so advanced that there's like mini businesses, they're highly technologically advanced. They could potentially be training people in the civilian or giving lectures at universities for practical, hands-on sort of job, knowledge. So I will finalize. Oops, sorry, it's Russia already. So I'll finalize here. It's a wonderful, critically important contribution. I'm very happy to read. I'm looking forward to read more. It is not only descriptive. I think it does go into the robustness checks, and the policy implications will all be looking forward to your future work. Thank you.
Our next discussant, Alessandra Fogli.
Okay, so first of all, thank you so much for inviting me here. It's a really pleasure to be here, and particularly meaningful given that I am an European that lives in US. It's it's really, meaningful to be here today with you. So it's been a pleasure to read this paper. It's really a fascinating, detailed account of the workings of the labor market in Ukraine during the war. And it is a particularly precious window on how these labor markets works in a time in which usually during the war, data availability is very scarce. So this paper provides a microanalysis of the labor market during wartime, and they showed three things. First of all, that there was a massive shocks to the labor supply as well as to the labor demand, larger reallocation across the region and sectors of economic activity, but also a surprising resilience in the matching efficiency. And in particular, the reason for this surprising resilience are to be found in the introduction of remote work, so flexibility, wage flexibility, and flexibility in recruitment policies. So today I'm going to first summarize these results. I'll go fast because Tito did a good job, presenting them. And then I will talk about the 3 notes of caution. One is to do with measurement of these flows. One is to do with the coverage, the sample, and the limitation of this particular data set. And then the third is about institutional constraints that where it works during this big, massive reallocation. And then conclude with the policy implication. So first of all, I didn't know, but massive shock to the labor supply. So one of the largest labor supply shock in modern history, driven by this large migration. We're talking about 6 million people that left the country. And the shock has been large and persistent. On the other hand, the shock to the labor demand is also big, but has recovered. So it looks like there has been some sort of mismatch in the last few years between demand and supply. In addition, great big reallocation across regions, so from the east to the west, and across sectors, so from sectors that were into consumer services to, of course, military-related activities, and as well as a formal to informal sector and private to public. In spite of this large reallocation and massive shocks, there was a pretty good recovery in terms of the aggregate unemployment rate. And so the paper is asking what is really working behind the scene? What are the micro channels through which the aggregates look pretty stable and were able to recover quickly? So basically what they do is to understand this resilience, the source of the surprising resilience, they estimate a Cobb-Douglas matching function using these platforms where there are all these vacancies and CVs and demand for jobs. And so basically it's just a simple matching function, Cobb-Douglas, where the matching efficiency is captured by the term A. And the term A is equal to some constant, but then there is an indicator that is capturing whether the war has changed the efficiency of the matching. So the matching depends on how many vacancy, in the stock of vacancy, in the stock of unemployment, but also may vary over time, the efficiency of this matching, depending on whether there is the war. So gamma is capturing this time effect. So, and of course, they have also region effects and the category fixed effects. So what they find? They find, first of all, that yes, there is a cost return to scale technology, so the elasticity to the unemployment stock and to the vacancy stock sum to 1. But also the matching efficiency, the gamma terms, is negative and significant. So the war did decrease the matching efficiency. However, in moderate terms, so the drop is only about 15%, and is comparable to other, kind of shocks that we observed in the past, like the Great Recession in US, where the efficiency dropped by 25%, for example, even more. So the mechanisms that preserve matching efficiency, I was mentioning before, flexibility in wages and flexibility in recruiting. So surge in remote work and a massive entrance of new marginal workers like women and as well as disabled in the workforce. So the 3 reasons to be cautious. The first one is a measurement issue. The second one has to do with the selection, the sample selection of this particular data set. And then the third one is the institutional changes that happen at the same time. So basically, the way Tito was telling you, they constructed this measure of matching is by looking at the variation in the stock of vacancies. So when vacancies disappear from the data set, they are considered filled. And so basically, there is an implicit assumption that vacancies are either filled or keep on being posted. So in times of a war, you can think that there is a lot of uncertainty and mobilization rates and the migration. So my expectation is that, there could be some posting that either close or do not exist anymore. Now, in that case, the matching will be overestimated because you will consider field posting that are not there anymore for other reasons that is not being filled, but because they've been closed. Even if they stay there, but they don't exist anymore, like Tito was saying before, it's still creating, a measurement issue. So the approach is, has its limitation. At the same time, I was looking, and this is also something that and you were showing before, the other discussant, showing that if you look at the different survey, asking directly the entrepreneurs whether they found hard to recruit, so the percentage of them, saying that it's getting harder and harder, is skyrocketing and is now about 60% at peak levels over time. And at the same time, there is also a significant upward pressure on wages. And this is in the next panel. So my understanding is that the supply shock was probably more persistent, the demand shock recovered, creating, some mismatch. So why there is a mismatch that, it's not in this data, not in the other data set. So basically, if you look at another data set, that is the state employment service data, you find that the placement flows did not recover. So if you look at the number of job placement per month or the number of individuals who exit unemployment by finding a job, those did not recover. So how do we explain that in one data set you find, matching efficiency did not decline much, but in the other data set it seems like it does? So basically here I plotted the coverage of of vacancies in the two different data sets. So the blue line is showing you the vacancies as registered by the platform. And the light blue line instead is the one that is coming from the employment survey. And so basically there is a difference in the sectors that are covered. So the online platform is much more skewed toward sectors and toward workers that are connected. So formal firms, white collar, IT, services, digitally connected workers, and firms able to operate remotely in less exposed regions. So basically this segment recovered quickly, quindi the matching looks resilient. And this is the data set that is used in the paper. The other source of data instead is has a different sample. So basically is mostly blue collar occupation are prevalent. Construction, manufacturing, workers with low digital access, displaced, vulnerable workers. So for this segment, instead, the recovery was low or did not happen at all. So there was a dual, working of the markets, and it was not overall, that the matching efficiency recovered as much. So the other, possible source of bias one has to take into account is the classic firm survival bias. That is, in the data set that they are considering only the firms that eventually were in the more protected areas that survived, that were stronger and resilient, are still there posting vacancies. So they are probably those that are also able to better face, the challenges. So basically, this resilience cannot really be applied to all firms and all sectors in the economy. The other interesting thing that I thought, to bring up is that efficiency always good? So what is this matching efficiency really capturing? And there are reasons to, think about whether, these are, workings of the market that we want to keep, once the war, hopefully, is over. And so something that happened was that there was the martial law. There were emergency labor rules that were imposed. So simplified contracts, suspended inspection, extended hour, relaxed overtime, and hazard rules. together with lifted gender-based bans. So basically, these measures, yes, they made more efficient, to recruit workers because there are no more regulations. But on the other hand, they also lowered the protection of workers. So there is something to keep in mind. Which of them, you want to keep and which you want to remove. And the key policy question then it becomes which wartime flexibilities can inform better future labor policy and which must be reversed to restore essential protection. And also the fact that there was this massive reallocation, flexible labor markets, really individuals had to, be displaced and leave their regions and and their networks and their to find new jobs in different areas and under different conditions. So also this relocation has been really costly. It's not always something that is completely positive. So the war participation, so some gaps closed and some others opened. And this is a little bit what I learned, from reading this paper. So women entered male-dominated sectors because the gender ban were lifted. Older workers displaced person took up remote and part-time jobs, but regional and sectoral divides actually deepened. So much more, gap between the West and the Eastern part of the country, much more gaps, in firms that were able to manage, and those that started disappeared, as well as different sectors. So reconstruction must bridge these new divides. Some divides closed, but some other opened. And so those are those that, policy should take into account. So convert the wartime flexibility into sustainable, fair labor practice looking forward, retain the productive simplifications, in particular also, retain the lift to the gender bans. Something that we have learned, that I've learned, from this work on gender and women labor force participation, is that it's true that the immediate effect of the shock may eventually die out. That is, the women that enter in those during war period and eventually come back and leave the labor market. But the new generation usually have, sort of like a much higher probability of entering the market. So even if in the short term, the shock may be temporary, there can be long-term consequences in lifting the ban and having, 50% of the population enter in mass the labor force. Also, because of the regional gaps, local employment services become important. And because of the distraction of the new generation that had to deal with the work and the closing of the school, the human capital for the next generation is something that will be crucial. So at the end, I think this is a precious contribution. I learned a lot about Ukraine during wartime. Clear signs of adaptability, of efficiency, of resilience, but in some regions and in some sectors more than in the others, probably. It is hard to measure, these quantities and these phenomena in the data. And in terms of policy implication, retain adaptable practices, rebuild the core protection, extend the recovery to the lagging groups and regions that are now left behind. Thank you.
Thank you very much. Okay, questions? Ed, and then Fabrizio, and then I'll come to, okay, I'll go like this. Why don't you go now?
So Tito, this is great, and I learned a lot, and I particularly love the alarms, and I thought it was really, really neat. I did wonder if you were phrasing the question in the most effective way that it could have been phrased. In a sense, you're asking the question, what did the war do to the functioning of labor markets, right? And in some sense, the more important question is, how well are labor markets contributing to winning the war? Right. And they're not wildly different questions, but they're slightly different questions in terms of the phrasing. And I'm sort of reminded of this 1943 speech that Franklin Delano Roosevelt gave, where he used to be Dr. New Deal and now he's Dr. Win the War. And there is a sense in which sort of asking about how well the war did to sort of the speed of matching. seems less important than the question of, look, we've got a war, we start with the labor market, which is full of young men working in a bunch of peacetime industries. And we've got to get to a labor market in which we've got a whole bunch of industries that are really crucial for the war effort. They're employing people who might not have been employed. And on top of that, a whole bunch of people just left, right? So like that feels like if I was sort of thinking about how well Ukraine was doing it, I'd sort of start by saying, like, what's the end goal? What's the beginning goal? How well are sort of the path of wages and employment changes getting us to it? What can I say about where is it going more quickly than? I think it's all there. It's just a question of like rephrasing it slightly and sort of focusing a little bit more on like adapting to the needs of areas. I think it's perfectly fine to ask the questions like what's happening to wages, what's happening to unemployment. That's great, but I think you get through that relatively quickly, and then you sort of ask like, what have we learned about how economies retool themselves for a military thing? The last sort of thing that I found really fascinating is the sort of labor markets that shut down in the East, and what exactly is going on there. I mean, I've spent a lot of Zoom calls with people in Kharkiv over the last 3 years, and it seemed like certainly no one was out like starting new firms and doing stuff. I mean, they're sort of dealing with chaos around them. But it's sort of interesting to sort of just understand what's going on when sort of everything breaks down, which is and sort of have an image of sort of Berlin 45 or other places where sort of chaos has ranged. But it's great, thank you.
Nice. It's very interesting. I have a question about your demand shock. So you can say there's a demand shock, but the evidence for it was a bunch of firms are undermanned. So I was wondering, could it be that actually it was just a supply shock and just the firms had to adapt? So they look undermanned, but not because they didn't have demand, just because they didn't have the workers, so they had to do with less workers. So, and then maybe reduce matching efficiency, it's harder to find a job, but maybe I don't know. It depends on the location, I guess. But I'm wondering whether Kiev maybe was not much of a labor demand shock.
Quick, thanks.
Yeah, just going from Ed's comment that no one is starting new firms. So if you take this in a forward-looking direction, how well do you think the lessons from the negative shock poured over to when the war is over and there's a positive shock? So do you expect that kind of surprisingly good matching to continue in the future, or what would be better, or what would be the impediments to it?
No, sorry, last one. It's about policy implications, so your recommendations. I was wondering whether, of course, it's on domestic policies, but I wonder whether you can expand it to include the funding effort that is already on the ground. So there are already about $2.5 billion deployed by the Multilateral Development Bank, mainly the EBRD. So there is a program called Learn. It's about $600 million, which is actually in place right now. And then there will be more money coming up post conflict. Now, I was wondering, Ukraine has a low rate of capital absorption, and I think the conclusion of your paper could be of great interest for again planning this reconstruction and the intervention now, because it's absolutely true that the question is how to make the Ukrainians to win the war, and so increase the way to absorb capital and be more efficient. Thank you. Microphone.
This is clarification. So if I'm in Ukraine and I'm an entrepreneur and I'm looking for somebody who knows how to use a particular computer controlled cutting tool, right? And then after the war, all those guys leave for Turkey or they're in the army, and it's going to take me forever to fill that job. But it could be that from the existing pool of people, I fill it as quickly as possible, right? So to what extent does the efficiency measure? Should I be worried that the efficiency measure is confounding the fact that the labor market is that the supply of workers has changed,
with the fact that people are hiding in their basements 2 days a week. Right? I just didn't understand that.
Okay.
Sorry, I have one last question. It relates a little bit to Ed and also to Fabrizio's. And maybe you mentioned this, but how good data do you have across sectors? Because you could think some sectors really face a demand shock. I don't know, tourism inside Ukraine. Probably no one wants to run. So here you should see some effect on wages and employment, but other sectors, you could tease out more of a supply shock in the sense that, it tends to hire people of the ones that are recruited now by the government and so on. So I saw the general statistics and a little bit on the sector statistics. Could we do more to tease these two out across sectors? Thank you.
Okay, take it over.
Well, thank you so much for a beautiful discussion, Elena and Alessandra. No, very, very, very important remarks. Clearly, I'm not going to answer because some of the comments were actually suggestions for improvement, and we certainly are going to address them. Military, we can do better, clearly, in tracking, especially if we move in the direction that Ed was suggesting. Clearly, we should work a bit on that, clearly by looking also at input-output tables and seeing all the intersectoral linkages that are required. So understanding to which extent all of this is related to military effort. There is literature on productivity spillovers related to this expansion of the military, although sometimes, in my view, is overstated, this thing. We also have been looking at some productivity data, and clearly that is something we can address. Elena, you raise an important issue concerning migration, return, and the crime scheming. I think one of the things we are learning from this experience is that there has been a sort of decoupling between the physical migration of people and the migration of ideas and capital and interaction with the local people. So the fact that so many people are still away, but they are also contributing to the economic activity in the Ukraine is very important. And is a new, I think, to a large extent, phenomenon also related to the possibility that are offered by remote working. There was certainly crime scheming, and clearly that affected the labor force participation among the stayers. Indeed, that may explain why we initially saw also this decline in nominal wages, that I think is very much related to a compositional effect. But certainly these are things that, well, I would like to thank Alessandra for having summarized so well our paper, and I will steal some of your slides, perhaps in the future. I agree that we don't cover the entire labor market. We do cover mainly the digital labor market. Still is an important component, and one that is going to expand over time, because we see this in many other countries, that the digital part of the labor market is getting larger and larger. Clearly, not all jobs can be remotable. We know that. We have been studying this also in the past. I'm pretty confident, though, about the statistics we use, for the very fact that the policy that is being followed by this platform, with many interaction with them, is one of cleaning only insofar as the firm posting the vacancy stop subscribing. But the subscription is related to the inflow vacancy, not to the duration of vacancy. So they have no extra costs in keeping the vacancy there. So I think, given that we don't have data, and also if you look at how we reconstruct the story, things seem to be pretty, and the vacancy filling rate is in line with what we had seen also in the past. It's not that we get numbers that are completely, but I agree with you. Ideally, if you could have data on matching from the public employment service at the same frequency and same level, that would be nice also to expand in that direction. Unfortunately, these data are not available. I'm not so sure about the institutional part that you mentioned. true, clearly under a military condition, the labor market is operating differently. But typically under military conditions, also the controls are to some extent tighter than in cases and we been discussing also with labor lawyers and so on, and there has not been major reforms of the institution in the Ukraine as far as we know, that have changed completely the landscape in terms of employment protection legislation I'm not so sure that there has been really this induced flexibility at the cost of protection that you were depicting there. Although clearly, certainly there is an issue of protection of these workers, and that's something that we do discuss there. In particular, there are new groups that are marginalized by the war. We have the veterans. Veteran is going to be extremely difficult to reabsorb them, but also the former refugees, those who will come back from the literature we have been surveying, also in previous cases of wars, the refugees were really a group that was very difficult to reabsorb into the ranks of employment, so that we require policies where what's happening in the shutdown areas, in the exposed? That's a very interesting question. We see this practically shutdown of a market. Firms are no longer posting vacancies, perhaps because they don't know how long this territory will be there. So people really, it's very hard to get any measure, but it would be nice to have more insights about that. On the size of the labor supply shock, Fabrizio was asking, the labor demand shock. Yeah, true, there was overmanning already before. Overmanning is not necessarily a measure. Though I think there was a labor demand shock, and that you can see from the wage dynamics at the beginning of the war. If it had been entirely a labor supply shock, then you would have not seen this initial drop in wages. So there were firms that closed down operations, shut down. This is seen, and there are data also suggesting that. So I wouldn't, although it's not as large as the labor supply and it is less persistent, I think there was a labor supply shock, a labor demand shock. Clearly, measuring it properly is not easy. Moving from a negative to a positive shock, that will clearly challenge a lot of the policies. We have to see how large is going to be the positive shock. It certainly is not going to be that large because return migration is unlikely to occur on a large scale. The country is aging, so indeed, to some extent, we think that some of the lessons that we are learning from this story can also be applied to countries that will suffer, as many OECD countries, a decline in the labor supply. Well, data, I think I'm not sure. I did take note of all the other remarks that were made. Yes, clearly the fact that a vacancy is being filled doesn't tell us much about the quality of the job and the quality of a match being created. Ideally we should have micro level data. We only have aggregate data by region and or by occupational category. The data, the quality of the data, the big advantage of the data on the platform is the frequency more than the disaggregation. Of course, we cannot be reassured that the match taking place is also a good match. Possibly, and unfortunately, we can also look at the duration of a match. That could be another indication of the quality of a match. But unfortunately, not having micro data is not something we could possibly do. But I agree with you. That would be very, very important in understanding, better understanding, getting a measure of the quality of a matching that goes beyond this embodied term, like, although this is what typically the literature does. I'm sure I missed many questions, but perhaps also Giacomo has something. And
yeah, a couple of things. One, on defense data, we don't have any micro level evidence on who the people conscripted into the military are, where they were working on. But yeah, we could like see the difference from before the war to after, but we don't really know much about the soldiers. One potential thing after the war would be if this data are released, then it would be very interesting to study this. One addition to why we use the online platform data is that the administrative data are usually released yearly. So we have only like 3-4 observations. Also on your question about the sectors, how much can be done better, I'm not sure there is a margin there to do much better. One thing on remote.
Well, let me just make it clear. So let's say, for example, we know that a whole bunch of people need to go into ammunition supply, right? And you know by the end. And in some sense, you can then trace out how that happens and how quickly that happens. So how quickly do wages go up? How quickly do the vacancies are posting? How quickly are they filled? Like that whole sort of process gives you a window into how quickly, how well the Ukrainian economy is adjusting to the war. That's the sort of thing that I had in mind.
On the platforms, but it's only posted and asked. It's
then you would have like the market platform that work massive, right? So if you're searching longer, you get lower labor costs, and that's also that gives you a measure of how much work you're making.
Yeah, we have aggregate data though. I mean, that's so.
That's another margin. The potentially what could do, look at individual postings and resumes in the platform in the future. We only have aggregates that the platform provided us. One thing on remote working, it's very interesting, is that we looked into a survey that found that people working remotely from abroad are more likely to come back to state that they would come back to Ukraine in the future. So that's been really an important attachment mechanism.
Beatrice, just one comment or question, whether you can position the paper even more broadly, at least by attempting to also think about what could be consequences for Europe, because some major relocation needs to happen here too. And of course, it's not happening under the threat of drones yet and bombs, but I think that might be also a way of positioning it.
Yeah, and also this question involves also whether Europe is going to, in a way, draw on this specialization of the Ukraine, given that it has to make all of this military and rearm effort. Maybe an efficient way to do so would be to exploit clearly the investment that have been made in the Ukraine. In that case, then the specialization that developed during the war may become also something that lasts beyond the war.
Can I say one thing on the European side? There's been the activation of the directive that allow people to choose where to reallocate in Europe. That has led to a more balanced distribution if you compare the spread, for example, with the Syrian refugees in the past. So this has been, I think, quite important in the absorption of this.
At the same time, it will be more difficult to return migration because these people found jobs and are quite well integrated in the country we went to. So that's why I'm a bit skeptical about having soon a positive labor supply shock. And I think we need also the reconstruction will be necessarily absorbing a lot of migrant labor from other countries and avoid them.
Just very quickly on this integration to the labor market, but we're not allowing these people to get de-skilled because with the Syrians, we let them, the soonest processing time was 6 months, completely random. There are plenty of research that some people with completely similar skill sets and CVs would get 2 years and more processing times. And by that time, after you came from Turkey, you're completely de-skilled. So then there's no sort of skilled person to come back to. Here we have a debate whether they will contribute to Ukrainian productivity or European productivity, but at least they're contributing to productivity. So that's all I wanted to say.
Okay. Let me just allow the online question and then we go to Andre. Go ahead.
Okay, do you hear me? Hello?
Yes, yes.
Okay, great. There are a few comments on the great comments which were supplied to our paper. First of all, I will go very quickly about alarms. Yes, a lot of people don't react to alarms as quickly as it was at the start, but it critically depends on where they are and how they expect whether it is dangerous. For example, if we take a look on Ukrainian underground stations, they are filled almost every night when there is an alarm, because some parts of the city are more affected by strikes than others, and people in these parts they prefer to move to the underground or otherwise hide, or at least stay behind two walls as a general rule. And if we took a look at a survey of firms by the Institute of Economic Research, the number one problem for the whole economy is shortage of workers, but the number two problem for the last year at least is unsafe to work. So a lot of businesses say that it is more important than, for example, rising prices or some logistical issues and so on. About coverage issues, yes, definitely the coverage is lacking, and say elderly who are not as digitally literate have less access. But for example, we can look that one of the categories we have is agriculture. As you can expect, agriculture maybe is maybe less digitalized sphere than, for example, IT or logistics. But there are some number of vacancies every month, so these regions are covered too, even if they're not covered as well, definitely. About the post-war migration, I agree that it can be a problem, that currently a lot of men are unable to leave, while women and their wives and children are away, and if their wives and children are adopted in the new places, it is possible that after the war the limits to movement will be lifted, and a lot of families will be united not in Ukraine, where women with children will return, but abroad where men will go. And this is definitely a problem which have to be previewed, and some policies should be made even now. About the mismatch of skills, yes, there is a serious mismatch of skills. It was even before, and therefore, if you take a look at, for example, Ukrainian unemployment rate before the full-scale invasion, it was about 9 to 10%. It's quite high, especially bearing in mind that it seems that it have to be lower, and actually this is due to the mismatches which we have, because there are much less popular works in blue collar, so a lot of people don't go to blue collar jobs, and there are a lack of specialists in blue collar jobs, and this is a problem. Also on worker protection, maybe yes, this can be a problem, but in Ukraine this is an issue that there are some laws from the Soviet time even remained which give a quite serious formal protection, but they are often not forced enough to give real protection. And there are cases when the situation is changed. For example, before the full-scale invasion, there was a case that or mining howlers, Ukraine holds iron ore, and the howlers, they move iron ore from the site where it is mined to the refinery factories. And this was a very dirty job. It was high noise, it was high dirt and so on. And they had the ability to go to the retirement at age of 40. Then there was change in the machines they use. The machines are closed, so there is not so much noise and so on. But when the firm tried to increase the rate when people go to retirement, there was a huge protest, and formally it based on the fact that yes, in the law it is said that these people should be retired early at this stage. And so if workers unite and organize in trade unions, they protect even despite the situation is changed. And actually the fact that they were protected because of some issues which are not longer relevant, it still affects the general situation. So this my main comments. Thanks for listening.
Thank you. Thank you. And last question, Andre.
Besides the massive movement of workers, there was also massive movement of firms. I don't have numbers for you, but from anecdotal evidence, a lot of firms in the south and the east, and even from Kiev, moved to the west. I'm curious, how do you think this may change your conclusions on labor market outcomes, efficiency of matching, etc.?
Yeah, we have been looking at the relocation of firms as well. I think that that could contribute to explain the heterogeneity across regions in the matching process. Well, it's not so clear about the selection that has been taking place in terms of the type of firms that did relocate. But certainly that is going to have an effect that will basically, unless we understand this selection, will be on the number of vacancies, not on the efficiency, strictly speaking. So we have to look at that perhaps more in detail, and there are not much data on the quality of firms being moving. Unfortunately, ideally we should have data of the type of Davis and Altivanger, looking at job turnover rate, entry, exit of firms. But unfortunately, we tried hard, but this type of things are not there. So, I agree with you. Another interesting thing about the Ukraine is the fact that collective bargaining is really not much developed, and clearly is not done at the centralized industry level or regional level. Otherwise, or the national level. Otherwise, that clearly would have strong implication for the type of phenomenon that you're talking about.
Okay, great. We are right on time with 1 minute past. So thank you so much. And we are dinner now, and tomorrow we start at 9. See you tomorrow.